full 5-day working week. And then, the Monday after, you get a bit of a reprieve. I'm Prashant, with me, my colleague Sonia and Nigel. Guys, hi, morning.
Hi, morning. I'm getting good feeling about this week because we have some good numbers that the market will react to. ICICI Bank, top notch. Reliance Industries as well, better than expectations. So, could this be the week when the market moves out of its range, right? Or out of its slumber? That's the question.
And it has been a slumber, right? For the last 3 or 4 days, it's been absolutely in a very, very tight range. Global cues, I'll just wrap up in one sentence. Not very much. Absolutely not very much. So it's lackluster. They don't provide any sort of guidance in terms of what comes next. So that's it. That's all that you need to know. Looking ahead, there are some earnings, big global earnings from the likes of Microsoft, Google, Amazon, Caterpillar, GE. So it's actually a massive week of earnings in the US markets as well. Let's come straight to what will be the mover here for today. What will be the decider? We had strong fourth quarter numbers from both Reliance Industries and ICICI Bank. And we'll discuss this in greater detail. But both numbers were a beat. Now, stocks, I've always said, move based on how much of earnings been upgraded by. In the case of Reliance Industries, while the outlook is pretty positive, there's not been very much of that. ICICI Bank, of course, has hit it out of the park, which means even though there are concerns that, in the case of ICICI Bank, deposit growth still lags HDFC Bank, etc., numbers have seen sort of marginal to meaningful upgrades across the spectrum. We'll come to that a little later. The total weight of ICICI and Reliance in aggregate is 18% of the Nifty. So we're talking about a large chunk which is, beaten expectations, and that essentially could be the driver today. All right, for the Nifty to come to levels, last Monday's range still remains very, very relevant, both the high and the low. Through the course of last week, the Nifty remained within that range, last Monday's range.
YOY and about 13% on a month-on-month basis. So average spends are the second highest that you are seeing post-Diwali. Let's look at the top 4 performance. So performance for March, now with Citi's number being in the Axis details, a card market share for the top 4 has risen to 71.37% when compared to 68% in the previous month. Spends market share is at 74.74% for the month of March versus 71.9% on a month-on-month basis. Remember that Axis Bank's numbers now have Citi's numbers as well in March. So spends market share in spends is at 12% for Axis Bank versus 9% month-on-month, a gain of nearly about 300 basis points, while credit card issuances market share for Axis Bank now is at 14.2% versus 11.5% on a month-on-month basis, a gain of more than 270 basis points month-on-month. So in the top 4, due to Citi acquisition, Axis Bank has gained market share in spends by about 321 basis points. Ex-Citi, Axis Bank would have gained market share by 24 basis points. HDFC Bank has gained market share by almost 82 basis points to 27.4%. The top loser is ICICI Bank by about 189 basis points.
Welcome back to Basar Morning Call. I hope you're having a good morning. Well, as promised, let's get straight to the top stocks that you're tracking for you. Sonia, you go first. Reliance Industries, I think that's the one you're tracking top of the list.
Oh, absolutely. And, I think Reliance will do well this morning for a couple of reasons. One is that the numbers were very strong in Q4. They were better than what the street was estimating. It was an all-round beat. It was the highest ever quarterly profits that the company has reported, led by a very strong oil to chemicals business. The consolidated profits saw over a 20% growth. The EBITDA margins have improved, but the star of the show really was the oil to chemicals business. So if you look at it, the EBITDA in the O2C business was up 17% quarter on quarter, and from being single-digit margins last quarter, it's now moved to almost 13% margins in the oil to chemical business. So the street will like that. Jio also reported a steady performance this time despite no tariff hikes. There was a good revenue growth, and the average revenue per user on a year-on-year basis has gone up almost 7%. Most brokerages have, given a thumbs up to the numbers this time. Morgan Stanley says it beat street estimates. The energy vertical is what drove the beat this time. Kotak Institutional Equities has reiterated a buy with a revised target price of 2,800. It remains their preferred pick as well. While Jefferies has upgraded the stock, they say that apart from the oil to chemicals business, retail is growing at a scorching pace and should add an additional 30% compounded EBITDA growth in the retail vertical particularly. Of course, standard disclaimer, Reliance Industries is the owner of the channel that you're watching. It owns Network 18 and TV 18. But I reckon that the numbers will be taken very well by the street. Also remember, the valuations are now close to the lower end of what the historic valuations have been. So the risk reward looks favorable according to a lot of brokerages.
Absolutely. Harshvardhan Dole and Balaji Subramaniam will be with us to discuss more about the Reliance fourth quarter results. That's coming up a little later here on the show. So that's Reliance. But the other one is ICICI Bank fourth quarter numbers, and numbers are a clear beat. Net interest margins, especially the highlight. Abhishek is here to wrap this up for us. Abhishek, morning.
Morning, Prashant. So, Sandeep Bakshi has created records in ICICI Bank in Q4 FY23 results. One of the best record is that the net interest margin is at all-time high at 4.9%, with the domestic net interest margin crossing the 5% level for the first time ever. Even the international net interest margin is at 26-quarter high. So, the NII growth of 40.2% YOY is perhaps the best that you are seeing in last.
But yes, it definitely has the potential to do that. But give it time. Give it time. Don't expect fireworks on day one.
All right. Hi, Prakash. Good morning. Prakash, let's talk about the HDFC Group. You had, RBI commentary that came out on Friday, and it'll be positive. It's a step in the right direction for the merger. But I want to focus on HDFC Life. Yes, there are challenges to the business, and post, what we've heard in the budget, there's a very, very negative sentiment for the stock on the whole. Even after the positive update that we got, the stock corrected 5% from the top on Friday. But now the overhang with regard to that 49% stake, it will not come down to 30%. There's an option for the HDFC Group to go ahead and increase stake to around 50%. What's your view on the stock at current reckoning?
So, Nigel, that's a very fair point that you bring this out. While the HDFC Bank and HDFC Limited merger has been given a lot of relief, if not all of those areas, but especially on the PSL, which we'll talk separately. I think the HDFC Life, HDFC Ergo waiver of sorts to own 50% is a big positive. It's a big positive for both these companies, for these subsidiaries, because there's this overhang that they would have to get out while the business is doing well. And if you look at the recent numbers on the VNB side, I think organically HDFC Life tends to be in a far more stronger footing than it has ever been in the last many years, given the product mix that they have been focusing on. So when that growth happens, and if the parent does not have to dilute and somebody doesn't have to buy it because it's available at a distress or a compulsion of sorts, it's definitely going to be a positive. My sense is we'll probably start seeing it being the top performer in the life insurance pack for sure, given this removal of this overhang. But you also have to look at there's so much happening. Result season is on. There could be people who would probably want to do it only when the merger starts gets closer to being effective, and not necessarily right now. But I don't see any further losses or disappointment on HDFC Life from here on, given this particular factor which was impacting sentiment.
Okay, Prakash, stay with us. We're just coming back to you, but we've got two analysts joining in on Reliance Industries as well, which delivered a very strong fourth quarter showing. All-round beat on estimates. Strong show from the oil to chemicals business has driven a record quarterly profit, while margins have expanded as well. Harshvardhan Dole is Vice President Institutional Sales at Institutional Equities at IIFL, and Balaji Subramanian is Vice President at IIFL Securities. Gentlemen, great to have both of you here. Thank you very much for your time. Harshvardhan, if I can start with you, because the beat came from the sector that you have under your coverage, oil and gas. Sort of explain to us in context, how should we look at the numbers and the beat that we've seen, and what does it mean for the stock from here as well? Go on.
So the beat in the O2C came, in my opinion, on account of three things. One, there was higher production. Secondly, the benefits of fuel sourcing, which is both on petrochemical as well as on the refinery side, seem to have come through. And third, most importantly, is basically the operating efficiency. I'd also like to supplement that while globally the demand growth was a bit of an issue, domestically, all the three segments, which is polyester, polyester intermediaries, as well as polymers, saw a healthy demand growth in fourth quarter. And Reliance is favorably placed when it comes to the domestic market. So all these issues essentially led to a favorable performance on the oil to chemical segment. On the E&P, clearly the company seems to be benefiting out of a ramp up in the gas production. And at the same time, the realizations that they have got have been in sync with the global trends. So it's a benefit of volume ramp up as well as price being, favorable. These two combinations have led to almost, 60% growth, incrementally EBITDA being contributed from the old economy businesses.
Okay. Let's talk about the new businesses as well. Balaji Subramaniam, Vice President at IIFL Securities, joins in to tell us how he looked at the Geo business. Balaji, thanks a lot for being with us. So, for Geo, things were largely in line with estimates, no positive or negative surprise. But I think what stood out is the fact that there is this absence of a prepaid tariff hike, and that has actually slowed down the revenue growth on a year-on-year basis. How do you see the business shape up now over the next couple of quarters?
Good morning. Thanks for having me on the show. So as far as Reliance Jio is concerned, the performance was in line with estimates. It was quite steady. One thing which surprised a little bit on the positive side was that the revenue growth, if you take out the factor that this quarter had 2 fewer days, the QOQ revenue growth was almost 4%. So I would say these are pretty decent numbers. And what I think is happening is that in addition to the steady traction that they are seeing in the mobile business, businesses like fixed line, FTTH, and even enterprise for that matter, they have all started contributing a little bit. And that is what probably drove this fairly healthy performance. As far as 4G prepaid tariff hikes are concerned, my own sense is that probably, we are not going to see it in the next few months or so, because firstly, there is some weakness in the spending environment. And the other thing is that probably as we get closer to the end of this calendar year, we will be approaching closer to the elections. And I think in such circumstances, probably the earnings, the tariff hike that we have been waiting for might probably not play out this year. So in the interim, I think what will continue to drive revenue will be the steady subscriber additions, as well as the fact that some increase in data consumption can continue happening, because as the group gets into more and more, sporting events like what we are seeing in the IPL this quarter, or the Women's Premier League in the previous quarter, or FIFA World Cup before that, I think all of that will drive some data growth, and that will result in people upgrading to higher allowance packs.
Hi Balaji, good morning. Since we're talking about Jio, I just want to understand whether you're seeing it as a positive read-through for the telecom space on the whole, that the ARPU is held on a quarter-to-quarter basis. Some brokerages are suggesting that. So I ask you, is there any read-through for the telecom space?
See, my own read-through would be that the revenue growth being a little bit better sequentially, I think that should benefit Bharti as well. And Bharti also will have this extra tailwind where they did the tariff hike in the entry-level 2G plans, 2G prepaid plans. So as far as whatever data we have come through so far, that doesn't suggest that there is going to be a material churn on the subscriber front. So the subscriber churn will be manageable for Bharti, I believe, and you'll also have some increase in terms of the ARPU just because of that factor. So net, I think Bharti should also have a reasonably good quarter, but I won't expect it to be a blockbuster quarter, since as I said, the quarter has 2 fewer days, and there is no real 4G prepaid tariff hike tailwinds that will come through.
I think not too many people are talking about it, but the retail business has grown at a scorching pace this time around. Harshvardhan, I wanted your thoughts on it. Over 18,000 stores now is what they have. And, I think this time around the retail growth has been faster than what we've seen in the preceding 3 or 4 quarters. How much do you think that can add to the overall SOTP for Reliance, the fact that consumer businesses are growing at a very strong pace?
So the pace of, store addition continues to surprise us.
Yeah.
We thought that the store as well as the capacity addition will sort of slow down in fourth quarter. But to a surprise, that has continued. And it appears that the 100 million square feet mark is, maybe achieved in next couple of years' time, which was, seemingly quite distant. So if that continues, I think a 25% growth in sales as well as EBITDA is something which is a base case scenario for the retail business. I think if that were to happen, then a base case valuation of close to 100 to 110 billion dollars in terms of EV, that seems to be the base case for Reliance Retail from here on. And any move to delever the balance sheet out there, or induct a strategic investor, or do an innovate which is being talked about, is another trigger which probably will lead to re-rating of our valuation in that case.
Okay, all right. Gentlemen, we'll leave it there. Thank you very much for your time, both of you, and appreciate you running us through that. Balaji and Harshvardhan, it's a pleasure. Prakash is with us. Prakash, stay with us. We're just coming back. Want to get your thoughts on HDFC Bank as well when we return on the other side. Let's take a quick break. Sudarshan Sukhani, Mitesh Thakkar will also join in for some technical trading ideas. So those conversations coming up as well. Stay with us.
सदियों से चुप बैठी आज मुंह खोलूंगी, तोड़ के दरवाजे सारे आज सच मैं बोलूंगी, सहनशीलता को मेरी कमजोरी ना समझो तुम.
It's rare to see a 12-year-old speak about gender stereotypes, but for Swati, it's normal. She and her classmates have been part of Slam Out Loud's Jijivisha program for the last 8 months. And for them, such performances are a learning experience that teaches life skills and awareness around cultural and social issues. Swati is among around 12,000 children from disadvantaged communities across 5 Indian states who are learning creative confidence skills under Slam Out Loud's unique program that uses performance and visual arts to build socio-emotional learning skills.
For children who come from low-income backgrounds, all we do is restrict what we do with them to either academics or at best getting a job. And I thought somebody should be doing something about these children.
But what led to this idea?
One day I actually landed up in Kashmir, and when I walked into that class, I was doing this workshop. I asked children to pick an emotion and write a small poem on that emotion. And most children, like about 30 out of 35 children in that classroom, ended up writing about emotions of anger, confusion, sadness, hate, feelings of isolation. And I think on that particular day, I did not have a response to that as a teacher.
For Labru, the response is still not complete, but it's gaining form.
We are here at the Vikas Valley Public School in Delhi's Uttam Nagar area, where Slam Out Loud has been conducting the
Okay, welcome back. The SGX Nifty futures are indicating a 58-60 point higher start, 17,698. Let's get Anuj into the conversation. He's here with us in the studios to run us through what he's making of the setup. Very, very quiet week, Anuj, last one.
Yes.
So with Reliance and ICICI in the bag, maybe, some upsides.
Yes. Morning, Prashant. Morning, Sonia and Nigel. In fact, what I'm calling it a possibility of a blockbuster Monday because, if you can't have a breakout today, then you can kiss it goodbye. Spectacular numbers from ICICI Bank, no other way to put it. And stock has shot. If you see the last 3 or 4 days, Reliance numbers, of course, also beat on all parameters. Also prove this adage, old is gold, right? O2C business really delivering. And that stock has also not been, last 1 month it's done well, but over a 3-month period not been too great. I think the other important news is what happened really on Friday, the big relief which came in for the HDFC group of stocks, especially HDFC Life. My sense is HDFC Life could be today's stock of the day, actually. And of course, there's buyback announcement from Wipro. So across all sectors, you have positive news, start of expiry week. So as I said, if today also you don't break out, then it's negative. I think on the Nifty, what's interesting is all through last week, Nifty has been defending the 200-day moving average. It's been breaking that intraday. Current 200-day moving average is 17,605. It's been breaking that intraday, but defending it on a closing basis. This week's most crucial level, 17,750 to 17,850. If you cross 17,850, you see massive short covering. 17,700 call has huge open interest, 1.68 crore shares. As I said, we need to see the reaction to Reliance and ICICI Bank's numbers today. On the Bank Nifty, it's been one shade stronger than the Nifty, and ICICI Bank should support it, along with HDFC Bank. 42,000 put and 42,500 call have the highest open interest. My sense is, and I made this point last week as well, you can test new all-time high in May, provided you hold 41,500. It's gone through 1 week consolidation. If you cross 42,700, I think you're in for massive short covering again.
Okay, so exciting times perhaps. It's been, in a slumber for way too long, right? And hopefully these triggers will get the market going. But let's pose these questions to Mitesh Thakkar and Sudarshan Sukhani. Gentlemen, morning to both of you. Sudarshan, do you think this is the day when the market breaks out of that range? I mean, day or week, whatever. Do you think that, the market has enough in its arsenal to do that?
Good morning, Sonia. I think we are in an uptrending market and we are heading higher. I can't say whether we'll do that today or this week, but the trade is to be on the long side of the market. See, Sonia, we had a 1,000-point rally almost non-stop. After that rally, it's reasonable to assume that the markets will pause, consolidate, even dip a little, which is what they are doing. So this is not a change in the trend. It's just a consolidation after a sustained up move that we saw. This will eventually lead to another round, another leg of the up move. The difference likely is that we saw a straight line rally last time. This time markets alternate. So maybe we'll see a choppy advance, but markets will go up. So be on the long side of the market for today. Keep a stop under 17,550 and then let the market take over.
All right, fair enough. Mitesh, morning. What about you? How are you approaching things now?
Morning, Prashant. We've been having a very similar kind of an outlook that this is basically nothing but a sideways activity when the markets, will consolidate and the moving averages on the daily and the weekly chart will start catching up. I think that's happening. What is good is that despite the entire choppy last few days, the entire last week, in fact, the markets did not break the 200 average, which was the lower end of the range, which is around 17,550, 570 levels. I think it's moved up towards 17,575. But broadly, that level is held. And every time the market has gone there, the dip has been bought into. So I think that scenario remains. My sense is that another 1 or 2 more days of consolidation, and then you should start looking at possibility of a breakout on the upside. And 17,550 by default becomes the pivot, so you can keep the stop 10 points below.
Okay, all right, Mitesh, got the view on the index, but what about individual stocks? What are you looking at?
Yeah. So on the stock side, Nigel, I have 3 buys and a sell. On the buying side, a couple of crude-related items. Asian Paints is a buy with a stop at 28.55 for targets of 29.40, and Pidilite is a buy. Keep the stop at 24.15. Look for targets of around 2,500. AU Bank, after a big breakout, had a pullback for last few days. Now can be bought with a stop at 6.54 for targets of 6.90 to begin with. And India Cement is the only sell call with a stop at 180.5 for targets of around 170.
All right, and Sudarshan, how about you? What are the stock ideas for the day?
I also have a paint company. It's Berger Paints, luckily different. Berger Paints is a buy with a stop under 570. It's consolidating, and that consolidation should lead to a breakout. Sonia, one thing, you've been in the market for so long, just because we have a buying idea and the trader buys doesn't mean it has to go up in the next 10 minutes. You have to have a lot of patience, but these things work out if you have patience. So that was just a little speech.
Absolutely.
Cipla is a buy. All right. Cipla is a buying opportunity. It's making a fairly bullish cup and saucer pattern or head and shoulder or rounding bottom, whatever you call it. Again, a lot of patience, but it should give you good rewards. GNFC is an intraday short. The stock has been falling for the last 6 days. I don't know why. So it's an intraday short with a stop over 532. And finally, Lupin, which I came in my list earlier also last week, very large, narrow trading range has broken out. You have to take a position and stay there. Be long with a stop under 680.
Okay, thanks a lot for that. Absolutely. I mean, these are not recommendations that work by the hour or by the day, right? These are trends that you're talking about, and the trend is definitely on the upside. So just got to have a little patience, perhaps. Let's slip into a short break. On the other side, we'll be back with the pre-opening rates. We'll also speak with Ashutosh Mishra of Ashika Stockbroking to discuss about the big relief for the HDFC Twins and HDFC Life, as RBI has now given an approval for HDFC Bank to increase stake in HDFC Life and Argo. Stay tuned for more.
Walk along the streets of Kiev, of Kherson, of Kharkiv, and not a lot of people have a lot to say. Well, in Kherson, there's nobody around to say anything. In many parts of Kharkiv, there's nobody around to say anything on the streets. But war is on everyone's mind. How do you read that? Read it on the walls, on the paintings, the figures, the graffiti, the posters. Some people have said it there, others are seeing it there. Let's hear some of what Ukraine is saying without actually, of course, saying it. By the Krishatik street in Kiev, a row of posters remind passers-by of their Ukrainian past, as distinguished always now from a Soviet and particularly Russian past. Along the Freedom Square in Kharkiv, the word is out: keep calm and win. We will rule the cosmos. What is a marvel? It is the armed forces of Ukraine. Kharkiv is the hero city. Its people stand together. Everywhere, walls speak their tribute to the fallen. A flag for every fallen soldier, but that was at the start of the war. There is no room for many more flags here at the Maidan in Kiev. The plaques are long out of date. Updating them is just too difficult. The call to arms, the call to back the armed, speaks on every street. An SOS for ammunition, a cry against war, a salute to miraculous HIMARS missiles, and a loaded recall of a poem. Lovely maidens fall in love, but not with Muscovites. Remnants of old wars stand here and there. Preparation for the war underway is everywhere. While there is a chance, fight to the end.
Welcome back. This is Open Exchange, and we are coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, in a few minutes, we'll be getting the pre-open rate. So let's get in a couple of derivative strategies. Manoj Muralidharan joins us to help us out with exactly that. Hi, Manoj. Morning. Thanks so much for joining in. Monday morning, how are you approaching trade? What are the strategies and stocks?
Good morning, Nigel. The only difference that we look into this next 3 to 5 days, obviously it's a monthly rollover, and if you remember this uptrend that started into the April series, there was positioning into the May contract as well. That is, the open interest, we had seen it, I guess, the last week of March itself, were being positioned in May. So we believe that this uptrend has more legs. Now, the single intraday activity that happened on Friday, I would say that would be call selling at 17,700 strikes. So 17,730, that becomes a resistance for the day. Once that is breached, which we expect might happen, then there is a good possibility of 17,800. So this would be specifically intraday view that we have. Now, for the Bank Nifty, obviously, we believe that 42,400 on spot, that has been a resistance where the supply has come in. So once we see a breach of that, it opens up a good 800 more points in the upside as a target. So long rollovers into these two indices can come in. Stock specific, I guess, Bajaj Auto is holding good and the stock has good potential. So, but we would ask to get a trade into the March futures, not only get into an April one. So somewhere close to 4,300, it becomes a buy with a stop loss of 40 to 40, and the May series we're expecting at least a 4,400. So 4,380 to 4,400 becomes a target. And in the Bank Nifty, we believe that the PSU part, especially stocks like SBI, has shown good buying and follow-up buying. It's happened into this consolidation as well. So go for a 550 strike May option. I guess it is closer to 10 to 12 rupees. The potential is good. The target can be a good 24 on that. The stop loss should be 300 option.
Okay, thanks a lot for that, Manoj. For all of those ideas as well as your view on the markets. Appreciate your thoughts. Well, let's move on. The Reserve Bank has offered HDFC Bank relief on priority sector lending norms and has permitted the merged HDFC entity to hike stake in HDFC Ergo and HDFC Life to over 50% before the effective merger date. Ashutosh Mishra, the head of research institutional equities at Ashika Stockbroking, joins in. Prakash Diwan is also sitting by with us. Ashutosh, let me come to you first. What does this mean for HDFC Life? The stock has had a large underperformance, compared to the market, compared to its peers over the last many years. But from here on, what do you see as the stock move?
So I clearly see as a positive development for HDFC Life and HDFC Ergo both point of view, that now investors clearly know that no, the HDFC Bank will be holding 50% and they will also get benefit of the cross-selling to the HDFC customer in a bigger way because now they are direct subsidiary to the HDFC Bank. So in my view, this is very positive development. Yes, industry will be facing some issues on annualized premium equivalent because fourth quarter was very good. So compared to the fourth quarter, number may not look good in the first, second, or a few other quarter in the coming years. But we are going to see one of the largest concern getting addressed by this clarification from RBI.
Hi, Ashutosh. Morning. We had a good update that came in there, from HDFC Life. The stock had opened up well in the green, but the street seems to suggest that the good performance, because of the changes in the budget, could put FY24 growth at a risk. What are you factoring in for FY24 for HDFC Life?
Yeah, so FY24 will be a bit lackluster for the HDFC Life as such. The reason is purely that fourth quarter we have seen the type of AP growth which a few of the insurance company which has come out with the results is clearly indicating that everyone has delivered a very good number in fourth quarter, and all the regulatory changes has been kicked in from the 1st of the April. So the FY24 it will be more of a consolidation year for them. And going forward, the future prospect looks good. Yes, we are going to see some more tax changes in the future, but I don't think so that is concern at this point. I don't think so that is a concern at this point of time. So, in my view, this is more of a positive for the bank, for the HDFC Life at this point of time.
Prakash, can I get a view on HDFC Bank from you? We discussed the insurance, the life insurance company with you, but bank itself, I mean, what does it mean, what the RBI has told them now?
No, so what it does is it takes away a huge burden, potential burden from HDFC Bank's perspective to kind of, match up to those PSL, private sector lending allocations in a very short or a very near-term basis. It gives it enough time to be able to calibrate that. And, the change that's not been allowed is the CRR, SLR requirements have not been tweaked, which is fair enough because for a large balance sheet like this, you can't take those kind of risk and add to the systemic risk in the entire system. But my sense is the private sector lending tells you that they'll be able to focus more on the more lucrative businesses of corporate loans, of retail, and that's exactly where the margin improvement will happen much faster than what was expected. So what the street is going to do, Prashant, as we get closer to the effective merger date, the bank's net interest margin improvement, which is potentially likely to happen given the cost of funds lowering because of the combined entities' ability to raise low-cost money, that with the focus on retail and corporate and SME loans is going to be a very good combination. So what ICICI Bank has eventually done in these last 4 quarters, if you see, is something which HDFC Bank would do, and it's probably been holding itself back because of this merger. So that just goes out of the way. I think it's going to grow at a scorching pace once the merger takes off. And then this actually helps it do without looking back or over its shoulder in terms of, hey, I want to need to do private sector lending of this much. There's no restriction that will pull them back.
So for HDFC Life, right, I just want to pull up the stock because there are some brokerages that have upgraded the stock as well. MK has upgraded the stock and they have a target price of 650, which is well above the current market price. Prakash Diwan, your thoughts here? I mean, now that the overhang is out of the way, do you think HDFC Life can correct the underperformance it's seen over the last year or so?
No, absolutely, absolutely. And, a couple of days back, we were talking when Yash came up with this report in terms of why the last quarter was so lumpy, given the imminent regulatory change from 1st April. And Ashutosh also alluded to that. My sense is, Sonia, all of that will probably get digested in the next couple of quarters. Then you'll come back to a normal state of growth for most of these larger players, which have great distribution strength. Now, just imagine HDFC Life. One is everybody who wanted to buy a block of HDFC Life being sold by the parent, given this merger impact, is now going to be buying it on the screen. Yeah, so that's very clearly going to keep demand in place. The second thing that's going to happen is the expectation of AP, steady kind of growth not being there, or base effect coming into picture, and all of that is also means that people will not buy it at this levels. and that's where it starts offering a lot of value. So, the moment you start buying a stock which is going to do well only in 12 months or beyond 12 months, you start deriving a lot of value, not overpaying for it. So at 550 or 540, whatever, I don't know what it is opened up, it's definitely going to offer you a very significant upside from a large cap business in the financial services. So I'm quite positive on it. I would be surprised if you see those 650, 700 levels in the next 12, 24 months.
Okay. Ashutosh, thanks a lot for joining in and talking about this issue. And Prakash Diwan, thanks for commenting on HDFC Life as well. But before the pre-opening rates kick in fact, they have kicked in right now. So let's just take a look at the first numbers. For the headline index, it looks like it's going to be a good start, almost 80 points in the green. The stocks to watch out for, HDFC Life, big mover this morning. So 7% high on that stock. That overhang is clearly out of the way. The other two heavyweights are ICICI Bank and Reliance Industries, both batting for the bulls this morning. ICICI Bank is up about 2% while Reliance is up almost about 1%. Before we talk about more numbers, Prakash Diwan, just one more point on Reliance Industries that we made a mention of briefly, but I think assumes more importance through the course of the day, is the way they've managed their debt, right? So the net debt to EBITDA, despite all the capex, is still below 1 time in FY23. Even if you account for all the additional liabilities, payable spectrum, etc. And the company is now confident that they will maintain their net debt to EBITDA below 1 times despite capex. Do you think that's something that could give an additional fillip to the stock, or is it something that's already been priced in?
No, I don't think there's so much of goodness in the numbers in Reliance which has not been priced in. It's just languishing out there at these 2300 levels where if you do SOTP, and then I was very happy to hear you ask some of the previous guests on the retail side of the business. That's where 3,300 stores in a quarter, Sonia. I mean, we're talking about some of these chains don't even have that much in their lifetime. And you have a 65 million kind of square feet, which is already there. The moment they, get to those scales that they have put milestones on or targets on, without, this debt going beyond that 1%, 1 time, it's very simple. You have a balance sheet that's not likely to get stressed, whereas you'll have growth coming into the P&L very soon, and retail has already proven that. So my sense is O2C firing on all cylinders, gas, E&P, petchem, everything, refining, and retail doing so well. Telecom, of course, a price hike and things could change dramatically. I don't see any reason why, Reliance could probably be stuck at this zone of 2,400. So it has to move. It has to move. It's just a question of when. So, patient investors will definitely get rewarded if they look at it from that perspective.
Okay, all right. Prakash, thanks so much, Prakash, for stopping by. Wishing you a good Monday and a good week ahead as well. But it's 9:10 a.m., so let's go across to our technical experts. Sudarshan's back with us. Sudarshan, what's the 9:10 call?
Berger Paints. Berger Paints is a buy with a stop under 570 and, of course, long in the Nifty.
Okay, all right. Thanks, Mitesh. Thanks, Sudarshan, for that. Mitesh, let's come across to you.
I will also have a paint stock. Asian Paints is a buy with a stop at 28.55 for targets of 29.40.
All right, gentlemen, thanks a lot for that. By the way, I just wanted to mention a couple of more stocks. Macrotech Developers, we already got the Q4 update a while back, but the numbers have come through. The guidance is pretty strong, so Macrotech Developers will definitely be in focus. And of course, ICICI Bank is your big mover as well. Abhishek is here to give us the latest on that. Abhishek, splendid numbers this time.
Well, yes, Sandeep Bakshi has created history for ICICI Bank at records galore. So the net interest margin is at all-time high. Domestic net interest margin has crossed the 5% level. NII growth is one of the best in last 8 years, coming in at more than 40% YOY, which has aided the PAT to be the highest quarterly PAT that ICICI Bank has seen. So the return ratios are also splendid. ROA of 2.4% and ROE of 18.9% are the highest quarterly return ratios that you are seeing. Asset quality, one of the best in last 8 years or even more. The unsecured book, that's the highest in terms of percentage of the loans, 22-quarter high over there, coming in at 19.4% of the loans, and that is why the net interest margin continues to remain robust. On the flip side, the deposit growth YOY continues to remain at around industry level of about 10.9%, and going ahead, management has indicated that the net interest margin could moderate. However, in terms of P&L performance, both the NII and PAT is ahead of our poll. Now, brokerages remain upbeat on the stock. They say that ROE will increase to 17 to 18% in next 2 years. They have raised estimates between 3% to 9% over the next few years, and they see uptick in deposit mobilization to be a plus and expect it to aid the loan growth that the management has targeted. Now, management has targeted 18 to 20% loan growth in FY24. Operationally, it's an inline performance and market share continues to remain strong for ICICI Bank. So brokerages across remain positive on the stock. Target price ranging from 1100 to 1200 per share. Back to you.
Okay, thanks a lot for that. But it's clearly ICICI Bank and Reliance that could bat for the bulls this morning, and HDFC Life as well, which is your big Nifty gainer. So on Reliance, let's just put together some brokerages. The views are positive post the numbers. Morgan Stanley says that the company beat street estimates. It's the energy vertical that drove the EBITDA beat. But Kotak Institutional Equities also puts focus on the retail business, which is growing at a scorching pace. They reiterate buy with a revised target price of 2,800. They say that the company added 800 new stores in Q4 with a total addition of 3,000 stores in the fiscal, which means that the retail store footprint is now over 18,000 stores, which is a 20% growth compared to last year. Jefferies has upgraded the FY25 EBITDA by 3%. They say that this is the retail scorching space addition, which should add the EBITDA by 30% compounded growth rate. Now, the other big positive is the fact that despite all the capex, the net debt has remained flat, and Motilal Oswal points that out, where they reiterate a buy with a target price of 2,800, and they say that the entire capex was funded internally, and hence the net debt remained flat quarter on quarter, and that's something they liked. Finally, JP Morgan remains overweight with a price target of 29.60. They say that the risk reward is attractive, and the stock's underperformance that they've seen is unwarranted at the moment. So
okay, all right. Thanks a lot for that. Sonia, well, Rima joins us to tell us about Wipro. They've announced a buyback. Rima?
Thanks so much for that. So Wipro has said that when the company, the board meets for considering the numbers on the 27th of April, they will also consider a buyback. Now, this will be Wipro's 5th buyback in the last 7 years. Last year, the company did not do a buyback because they were focusing a little more on their M&A acquisitions. Now, JP Morgan estimates the buyback size could be $1.2 to $1.5 billion. Morgan Stanley says, based on the past buybacks, the range of the buyback could be from 6,500 going up to 10,500 crores. The cash in the books is ample at $2.7 billion. The past 3 buybacks by Wipro have been tender buybacks. So that's what the street is anticipating, because in a tender buyback, the promoter can also participate. The good part about a buyback right now, at least, is that it can lend some support to the price in case of stock volatility or uncertainty or weakness, given the current environment. Back to you.
Okay, thanks a lot for that. So just about getting ready for the market opening, and lots of stocks and lots of triggers actually that could aid the market. But will it take the markets out of the range? Time will tell. For now, 85 points in the green for the Nifty. HDFC Life is your top gainer. ICICI Bank posts stellar numbers. Wipro posts the buyback, and Reliance after a good set of numbers. You also have a lot of earnings coming through this week. There's IndusInd Bank that comes out today. There's the Bajaj Auto tomorrow, Maruti day after. So the market has plenty of cues to latch on to. And this will be the first set of auto numbers which will give you an indication whether, the trend is on the upside or not, followed by which you'll get FMCG numbers with HUL as well coming through on Thursday. So it's an action-packed week and looks like the market is going to open well in the green. So here's the first tick that we're getting on the index. It is well in the green, 80 points higher now on the Nifty. Whether it sustains, we'll get to know in a while, but for now, the first tick is positive. It's led largely by HDFC Life after that overhang is removed, so 6.5% higher. Wipro on that buyback is up 1.5%. ICICI Bank on strong numbers is up about 2%, and Reliance on good numbers and no further debt elevation is up almost about 1.5%. Apart from that, HCL Tech, Apollo Hospitals, IndusInd Bank ahead of its numbers today is in the green. So these are some stocks that are well in the green. The mid-cap index, by the way, is trending in the red. So there's a little bit of volatility in the broader markets. On the downside, Sun Pharma, Ekta was telling us about, the issues there, down 2.5%. Divi's, Dr. Reddy's are all in the red. In fact, the entire pharma piece is taking a bit of a backseat this morning. TCS is also under a bit of pressure. Powergrid, Bajaj Finserv, Britannia, Bajaj Auto are a couple of other stocks that are in the red. ITC is also, just stepped back a bit, so down about 0.3%. Nothing alarming there, but otherwise, it's a market that's giving up on its gains a little bit. The drag, as I said, is coming from pharma, but from the heavyweights, the drag is Infosys, TCS. So IT continues to keep a lid on the market's gains. M&M, Maruti Suzuki, Tata Motors are a couple of other stocks that are in the red this morning. So, given how good the Qs were, it's not a great opening, to be honest.
Well, that's right. Sonia, we're up 40 points from the high point of the day on the Nifty. Pat off the bat, and chasing that opening wouldn't have been very advisable. The Nifty Bank, that's going to be the crucial moving factor today. It's come off close around 100 points from the day's high. The high was closer around 42,470. You needed to get past that 42,500, 42,600. Resistance was met last week at both these two levels. So let's see whether or not we can get past that. Moving to individual stocks, Ami Organics, that stock is flying away. It's been a relative outperformer the last 1 month or so. They've acquired 55% stake in Baba Fine Chem. They forayed into the semiconductor industry. The stock is up close to around 2.3%. Going by the press release, it appears that margin-wise, it'll be accretive, and obviously EPS-wise as well, it'll be accretive. Maharashtra Seamless, they're backed an order worth close to 260 crores, so those order wins continue from ONGC. That stock is opened up in the green. Sri Digvijay Cement, well, they've got an environment clearance for expansion of its manufacturing facility. So, that's an important one that we're looking at. And we have some news that's coming in there. JM Financial Home Loans and Indostar Capital, they have explored for potential strategic options. So let's get both those two stocks up for you on the screen. So though the headline index has come off a little bit from the top, individual stocks have done quite well today.
Nigel, 30 points now, right? I mean, so this is a fair bit of comeback that we've seen already. But this is, the first act in what could be a multi-act, kind of day. But for now, we've come off quite a bit. The high is, 17,709. And we've come off about 50-60 odd points already. Let me just take a quick look at any other sort of names in the broader market which sort of Warren mentioned. So HDFC Life, of course, is the big one, as we've been highlighting. 7.25% higher. Raymond is up about 6% or so. That's coming up at about 1,583 rupees on Raymond. Decent sized volumes. There is HBL Power, which is coming up with about a 4.25% gain. Small name, but big volumes at this point in the day. Macrotech, the management joins us in a bit, 2% higher, 927. There is Persistent Systems, which is up about 1%, 1.25%. ICICI Pru was the last from the ICICI stable, the insurance company, to report numbers where the management with us. ICICI Lombard this morning is up about 1.9 or actually 2% or so in ICICI Lombard. Mirza International, I was talking about this on Friday. It's up another 8% this morning. Stocks at 65 or 66. And there is Indigo Paints, which is up another 4% after the move that we've seen. I think Thursday and Friday, both Indigo Paints did quite okay. So 2:1 is the overall advanced decline ratio. And these are some of the big volume-led gains that we've seen. On the downside, Zomato is coming up with a 2% cut. Sun Pharma, we mentioned. Yes Bank, we mentioned, I think 2.5 lower. Adani Green is down about 1.7%. Adani Green at about 900. And there is Dr. Reddy's, which is down about 1.25% or so as well. PVR is down 1%. So things are moving around. Maybe we'll have more in a bit. I can spot PI Industries, which is down about 1.5% as well. So 31.45 on PI Industries. Hindustan Zinc is another one which is down about 2.75% at about 315, 316. So volumes are still picking up. The market, which was, which sold off to being up only 30 points, is up about 45, 50 points now. So as I said, I think things will move around a little bit before they finally settle down. 17,675 or so is 17,675 is where the Nifty finds itself at.
What does it take for this market to come alive, right? I mean, you had everything today. You had Reliance, ICICI Bank, HDFC Life, Wipro.
35% of the index reacting to positive news flow of the weekend, but
even then.
But I'll tell you guys, it didn't look, looking at all the numbers and everything, right? I was making this point that not that as if there's been huge earnings upgrades or anything, right? Across all three names, these three names. We were mostly talking about the two earnings, ICICI and Reliance.
Yeah.
So it was that the sense was that maybe it'll get a flourish of a start and then maybe a little bit of a pullback. But let's see. I mean, the market bulls and bears will try and test the waters to see how much of this holds one way or the other. So you don't want to push it too hard if the momentum is in the other side. And that's why, usually it takes about an hour, hour and a half for, a market which is coming into with big numbers, earnings reactions to finally settle down and find some sort of equilibrium for the day.
Just one point. We're talking about the headline index. It's been a bit of a range, but the last few days, the mid cap and the small cap indices have started underperforming. And we had a good party in the first couple of weeks of April. So I'd like to see that come back, into form, because that's when portfolios feel good. And the last few days, we have seen some bit of underperformance coming in from the mid and the small cap index. But Prashant, our next guest is known as the master of mid and small cap. So let's go straight to him. Vineet Sambre.
Absolutely. Vineet is with us. He's head of equities at DSP Investment Managers. Vineet, good to have you with us here. Thanks very much for your time.
Hi, Prashant. Hi, everyone.
Hi. How are things looking, Vineet, to you? You've been cautioning about a little bit of slowdown in earnings at the margin. I remember after the third quarter, in the middle of the last quarter when we spoke, it's still early in the earnings season, but what are the trends that you're noticing?
So, Prashant, I think clearly, we are seeing some bit of moderation when we talk about the earnings because, largely linked to the consumption basket, and also more importantly, within the consumption basket, we are seeing that, the entry level or the, rural side or the bottom of the pyramid. I think that's the category which is sort of slowed a bit, and it is also maybe casting some bit of impact on the urban markets now. So I think there is some bit of that slowdown which is there. Maybe people are sort of wanting to save slightly more given where the inflation is right now. I mean, it is cooling off, but I think people just want to be on the side of a bit more caution is my sense. But I think, as we move along, there should be 2 or 3 aspects which we are sort of monitoring. So first of all, I think over the next 1 or 2 quarters, the impact of this slowdown should be felt, and we should see the recovery post that. And even with a moderate level of recovery, I think what could happen is that the companies which were also impacted because of the higher input prices, those are seeing the benefits now. So I believe that even if we may slow a bit in terms of the overall top line growth, the bottom line growth should start improving. It may not necessarily immediately in this quarter or next quarter, but beyond that, my sense is that should start happening. And it will be a good positive if, let's say pre-election led spend starts to improve the overall consumption, the investments which have taken place till now, those start showing up in terms of improvement in consumption. I think that will be a double sort of a positive for the market. So maybe over the course of next 1 or 2 quarters, we may bottom out as far as the markets are concerned is my sense.
Okay, you may bottom out. I think you're the second person telling us that this market may bottom out now. There was a global guest earlier in the day as well, Ed Yardeni, who said that the second half of the year could be much better than the first half. Just wanted to point out a couple of more stocks, right? Macrotech developers, actually the guidance was very strong for FY24. They spoke about a 20% increase in pre-sales. They're looking at 14,500 crores of pre-sales compared to 12,000 crores that they did in FY23. So the street is latching on to that. The other stock which I like is Cyient this morning. So another 3% rally. Remember, Cyient has put in almost 50% this year. So it's, outperformed all of its peers as well as done pretty well for itself. So these are just a couple of stocks in the broader markets. But Vineet, good morning and thanks for being with us on the channel. One thing is for sure that, there's a big trend that you're seeing where IT stocks have taken a backseat because of earnings and the impending recession, and banks have once again taken the leadership spot. Would you churn money out of IT and into banks now, or what is the most prudent strategy here?
So in fact, I think our overweight stance on banks continue, and we are watching that categories with more, let's say, carefully, because the fact is that, at some point, the NIMs would sort of peak out over the next 1 or 2 quarters, and then how the valuations at that point in time will, drive our decisions in that category. But for the IT sector, I think, Sonia, for us, it has been more a long-term view which we have to take here. We had trimmed some bit of our exposure early on, and we are slightly underweight on the sector. But we would like to, eventually own, some bit more of the from the IT sector, because we believe in the long-term growth potential of the sector. Just that the current dynamics would lead to some bit of more valuation correction is our sense, and hence we are sort of on the sidelines at the moment. Maybe at better price points, we want to accumulate the stocks within the category. Now, within that, I think the large caps have come off quite well, and there I think there is some bit of bottom formation happening. If we consider their free cash flow yields, they have reached decent levels. But as far as the mid cap pack is concerned, there I think still some bit of more stress looks like, given the fact that most of the end user is sort of again slowing, and the expectations around these companies are pretty high.
Hi Vineet, good morning. Nigel on this side. Vineet, it's been tough times actually for active fund managers. I'm looking at the performance of the last few years. Passive mutual funds, well, the returns have been a little bit better. My question to you is, given that we're in a challenging environment and maybe the headline index doesn't have too much on the way up, do you think that this time around active funds will make a comeback, say in the next 18 to 24 months? Because that will be contradictory to what we have seen in the previous 18 to 24 months.
Nigel, actually, I would believe in that, given the fact that last 2 years were also extraordinary. It was very difficult to really factor some of the changes which are taking place across different sectors, the quick moves which are taking place. So I think in that sense, it was more a beta market, and, just being present in those categories at the right time meant that, you get good returns. But I think going forward next 2 years, I would agree with you. It is more fundamental driven market, where your assessment of companies and businesses which are likely to outperform should drive the outperformance. And hence, I would believe that if one is putting up the portfolio more in a rational manner and trying to look for good prospects within that, I think stock selection should matter. And hence, there is a scope. I won't say that active will surely outperform, but there's a good scope for active fund managers to outperform over the next 1 or 2 years.
Vineet, you want to point us in the general right direction? If active is going to do well, it is going to be active stock picking, right? A few ideas, or rather point us in the right direction, general right direction, that will help. Where are you seeing opportunities now? Yeah.
So see, broadly, the way we are sort of thinking about looking at going overweight are, let's say, not focusing on sectors, but what are the trends where we are, putting our incremental capital. So one is that we are seeing a lot of companies which has made a decent amount of investments into capex in the last 2 years. I mean, last 2 years were difficult years in terms of the pandemic and all of that, but still there are a lot of companies which have done investments. Now, also the other fact is that while they have invested, they have not levered up the balance sheet. That is an important aspect. And in general, some of these companies have been generating decent ROEs. So I think that's a good combination where investments has happened, balance sheets are not levered, ROEs were good, and the growth is a bit slow at the moment for whatever reasons. So I think that's a good place to be in, because we will go by the management's instinct of seeing these investments paying off in terms of revenues, and that would also lead to higher profitability and higher ROCs as they move forward. So I think that's one pocket. The other pocket is basically where there has been a cyclical slowdown and the external environment has impacted some of the sectors. So as an example, healthcare is one sector where things were a bit slow, and the bigger impact was the profitability got affected because of higher input prices, higher freight cost and all of that. I think that's one category, and there are aligned categories similarly, agro-based companies and all of those, where the profitability has got hurt and the cycles were low. So I think that's one category where the cyclical recovery should play. The third category, broadly similar basket, is the automobile as a category, both auto ancillary, where not only India but world over we have slowdown and these cycles can change. So I think these are some, let's say, categories which we are sort of aligning our capital more towards.
Sure. I was going through some of the funds that you manage, just taking an example of the DSP Mid Cap Fund, right? You have a large presence in some of the spaces that have not done much for investors. For example, pharmaceuticals, names like Alchem Laboratories, Ipca Laboratories, something in the specialty chemical space like an Atul Limited. These stocks have really not done too much, and there are concerns here as well. What do you do with spaces like this? Do you churn out? Do you keep the faith?
Yeah, Surya, so I think we are keeping the faith. And as I said in my last answer, I think these are some of the names where they have seen, extraordinary impact because of, as I said, maybe higher input prices, and which has hurt their profitability, which is normalizing now. And my sense is that over the next 1 or 2 years, we should see the mean reversion actually helping these companies. And within the names you mentioned, I think the some of the specialty chemicals has done huge investments, not done in the last 5-7 years in their history. So I think those should also start benefiting these companies. So I think our sense is that we would like to keep faith in these names. And I think once these investments starts to benefit these companies, I think it will see its own, recovery in terms of performance as well.
All right. We hope for the sake of investors and for your fund that some of these stocks recover. Thanks a lot, Vineet, for joining in. It's been a challenging last 1 to 1.5 years. Hopefully, things will get better from here. But let's move on to a strong set of earnings from macro tech developers. The profits rose almost 40%, aided by a tax write-back. Their FY23 pre-sales are up 34%, but I think what the street really likes is the fact that the FY24 guidance is very strong. A 20% growth is what they're looking at. Abhishek Lodha, Managing Director and Chief Executive Officer at Macrotech Developers, joins us now to talk more about that. Abhishek, welcome to the show and thank you so much for being with us. It seems to be like a purple patch that the premium real estate market is in right now. I mean, demand is up, pricing has moved up after many, many years. And your guidance is quite aggressive as well. A 20% growth is what you're looking at in pre-sales. Can you just take us through what the market trend is now? Do you see a lot of that guidance coming in primarily through a volume uptick, or is it a pricing up move that you're seeing flow through as well?
Good morning, Sonia. I'm great to be with you this morning. Last year, we grew our sales by about 34%. And therefore, we have a high degree of confidence about the ability to grow at 20% for this upcoming fiscal 24, and also, in that same consistent manner beyond that. Our view is that we are in year 2 or year 3 of a long-term upcycle in residential real estate on the back of a number of factors, primarily being job creation, good wage growth, and good affordability. And that will keep driving this market forward, supported by the fact that the supply side continues to get more and more consolidated, as consumers as well as lenders are focused on only interacting and dealing with a few branded high-quality developers. Our growth forecast for fiscal 24 comprises of a price growth. We like our price growth to be below wage growth so that affordability keeps getting better. So we're looking at a 6 to 7% price growth and the balance 13 to 14% coming from volume growth. This combination, we think, is a healthy combination of reasonable volume growth accompanied by reasonable price growth, which keeps everybody's situation better. Older home buyers feel better because prices are growing, and new home buyers are feeling good because they see an appreciating asset, but at the same time, they're also seeing their affordability get better because wages are rising faster than price growth.
All right. Hi, Abhishek. Good morning. Congratulations on a good showing, and you're looking quite confident with regard to the coming year as well. So let's see how you go about that. We'll get back to the operational performance. A quick question on the debt number. Normally, you give us a guidance on that front as well. But I think this time around, that's missing. So what's the debt number likely to look, say, in the next 2 years, 2024, 2025? And also repatriation of funds from the UK investment. By when does that come in?
We are now very, very confident and comfortable with our balance sheet. We've given an overall longer-term debt ceiling, which is 1 times operating cash or 0.5 times our equity, whichever is lower. We believe that we will keep going below that ceiling in the years to come, i.e. we will keep reducing debt from the current levels that we have. At the same time, our overall operating cash flow as well as equity levels will keep going up. So we'll be well below that ceiling. We are probably the only real estate company in the country who last year showed not only significant growth in terms of new business development, adding 20,000 crores of new projects and investing about 2,400 crores for the acquisition of these projects. But at the same time, we were also able to reduce our debt by over 2,200 crores. This combination of strong underlying operating earnings, which allows both deleveraging as well as investing in growth, is unique in Indian real estate. And we believe that we'll keep capitalizing on that same trend, i.e. growing and investing for growth consistently, but at the same time continuing to reduce debt. On the UK front, we repatriated about 550 crores from the UK last year, and the balance of about 550 crores will get repatriated this year. And with that, all our investments in the UK would come to an end.
Abhishek, hi, good morning. I think many would be very happy to hear that what you said, right? You're only, you believe you're only in the second or the third year of a real estate upcycle. And when we say an upcycle in real estate, it's thought to be longer. I mean, it runs for 7-8 years. Are we in that kind of an upcycle? Abhishek, I mean, what is your assessment? You've been in the game a long time. Or do you think it's a shorter one?
Hi, Prashant. I think it's a longer one. I've been saying this for quite some time now. Earlier, people were skeptical, saying it was pent-up demand and then, various other theories. But my view is that with 100 million new households becoming home ownership capable over the next 7 to 10 years, this is a once in a lifetime of a country's period for housing. Housing will drive India's transition from low income to mid income, and housing will also be a beneficiary of India's transition from low income to mid income. We think the cycle is much longer. It's not 5-7 years. It's like a 15-year cycle. Of course, there may be 1 or 2 bad years in 15, but generally it's a long cycle, much longer than we've seen in the past, because there's a fundamental shift in the fact that we have consolidated supply and increasing demand.
So where else is the Lodha Group going to go now? I mean, the Mumbai market is largely saturated, right? Forget about houses. There's hardly any place for people to walk anymore.
I don't know if you're half familiar with this area, but around Matunga, I was driving down that highway, the Eastern Express Highway. And Abhishek, I noticed a very large project, a Lodha project coming up. I mean, I don't know how large, but it looked pretty, so to the point that where is the space? Yeah. And I was also surprised. Abhishek, you want to address that? That's a new project, right?
Yes, Shant, it is a new project. You of course keep your eyes very open. But to Sonia's point, I think, if New York and Tokyo can find spaces for continued development, India is very early in its cycle. And there's lots and lots of space available for development and various other means in every city, including in Mumbai. Our market share in Mumbai is just around 11%. So there's a lot of headroom for growth for us in our core market of Mumbai. And equally now, Pune is starting to play an increasingly important role for us in our growth. So Pune will also be a growth driver for the next 2 or 3 years. We believe that Mumbai and Pune by themselves will, take our sales from the current levels of 12,000 crores to about 21,000 crores by fiscal 26. So there's a lot of opportunity just in our core markets. And then we have our pilot phase ongoing in Bangalore. That's going to be pilot testing, but something which over the second half of the decade will be another driver of growth.
I was more looking at where else are you setting your eyes on? Of course, Mumbai, Pune is something that you've looked at for a while, but Ahmedabad, for example, has become the hot property destination now. Hyderabad is picking up in a big way. Anywhere else you'll be expanding over the next 1 to 2 years?
Sonia, the way we expand is we, test the waters in any new market in a pilot phase, invest in building the local knowledge, invest in building a strong team, and only then grow. So that's where we are in Bangalore. It'll take us 3 or 4 years for us to really become quote unquote local in Bangalore and then scale up. So that's really how we grow. We are not someone who, will go in and suddenly make a huge investment into a new market. We like to test the waters and only then expand. Those tips that you've given, Ahmedabad, Hyderabad, people have spoken about NCR, all of those are interesting. We'll be gradual in our approach. Current focus is Mumbai and Pune. And as I said, strengthening ourselves in Bangalore.
All right, Abhishek, always good hearing your thoughts. Thanks so much for stopping by. For me, the big takeaway is this time around, you believe that this real estate cycle will be for a longer period, maybe a 15-year period, in comparison to the traditional 5 to around 8 years that we have normally seen. All the best to you, and looking forward to having a chat with you all of the coming fiscal year. Well, time to move on then. Hindustan Zinc, well, they reported pretty much an inline set of numbers. Both the revenues, net profit as well had declined a little bit on a year-on-year basis, but that was on expected line. The margins were a little bit better as the cost of production dipped by around 6% on a sequential basis. To discuss the Q4 earnings and more importantly, the way ahead, we're joined by Mr. Arun Mishra, the CEO, Hindustan Zinc. Well, morning, Mr. Mishra. Thanks so much for joining in. Well, what are the odds you hit the upper end of that silver guidance of around 750 tons? I asked you this because the Fumer plant, you're saying it gets commissioned in the first quarter of FY24. So what's the guidance on silver volumes?
Yes, if the Fumer projects comes on stream in Q1, and also we are looking at some amount of tolling of lead MIC and getting it converted outside our facilities, we will get back some of the residues, silver carrying residues, which will be processed here. Two together, yes, we are very confident of beating this guidance of 750 tons.
Well, you're guiding for some cooling off in the COP. So just give us some color on, coal sourcing mix and where do you see it headed?
When we started the year, last year, we had a huge difficulty in sourcing domestic coal. It went as low as up to 5% when the desire is to get 30% domestic coal mix in our coal fed to power plant. Also, at the same time, the imported coal costs were very high. Fortunately, towards the end of the year, the imported coal prices have softened. And also our domestic coal production increased, and accordingly, we also received quite a good percentage of domestic coal. It went as high as 26%. If I look at round the year basis, I am quite confident with the current productions of WCL or ACCL. So we guess that it will be around 20% of domestic coal we'll get. And with international prices currently about $150 a ton, should soften further, can go down to $130 a ton. So overall, we should see a good commodity price benefit coming to our kitty. At the same time, we are reworking all contracting costs, including mining contracts, plant operational contracts, so that we are able to reduce costs there by consolidation and redesigning the contracts. So and also some work on the mine plants and operational efficiencies. Altogether, we should be able to go down to 1125 to 1175 level. Effort should be to go closer to 1125.
Mr. Mishra, given the sort of the growth dynamics overall, the oncoming slowdown perhaps as well, globally speaking, what is your own outlook as far as zinc prices go, sir?
No, I think current range should be between $2,800 to $3,000 per ton, because we had expected last year there will be strong rebound of economy in China. UK, Russia, Ukraine war would not last beyond 2 to 3 months. We expected that American inflation pressure will move away and Europe, demand will increase sharply. Some has happened, some have not happened. Russia-Ukraine war is still on. Uncertainty of energy sources is still there. China has not rebounded as sharply. And the current estimates world over is the demand for zinc is expected to grow only by 2.5 to 3% only. Fortunate part in India, the market remains still bullish. We saw good demand in Q4. There is a huge push by Government of India on infrastructure. Next year being election year, balanced infrastructure projects, there will be huge focus on completing them before the elections. And we guess that in India, the demand increase would be anywhere between 4% to 5%, far above than the global demand.
All right, and most of your sales will be in India, so that bodes well for you. But let's spice things up a little bit, Mr. Mishra. Now, going by the Government of India's communication on that they are not on board for Hindustan Zinc by Vedanta's international zinc assets. That's in the current form. Are you all working on some alternate strategy to convince the Government of India?
As far as we are concerned, it was a very good proposal, and it gives immediate boost to Hindustan Zinc's access to mineral. So it is still there, and we are talking to all shareholders. Government of India's letter says they expected us to explore more on non-cash mode of acquisition. So nothing is out of our consideration. We are studying all that, and I'm sure we will be able to convince our shareholders, and whenever everybody is on board, we will go for the regulatory approval.
Well, Mr. Mishra, you're sounding confident, but the other problem was valuations. It appears you were asking for peak valuations. Were valuations an issue?
As far as we are concerned, we have done the valuation fairly in a proper scientific manner. So I don't think there is any discussion on valuation.
All right, so you believe valuations is well fair. So you're looking at coming up with an alternative plan, is what the sense that I'm getting. What is the timeline for the outcome of these discussions that you're having?
Looking at the current conditions, we can't be putting a timeline, but I am sure it should happen sooner than later.
The one thing that the street definitely liked is in FY23, there was a big dividend that came through. So that's the next question. What is the dividend payout policy that we're looking at for FY24?
So while I won't comment on dividend, but otherwise fundamentals are still strong. Even if the price does not improve beyond $2,800 per ton, we will still be able to make a good cash flow of 10,000 crores at least after a year of operation with the guidance number we have given. So after that, it's up to the board to decide, and we'll leave it to the board to see whether with that earning, how do they want to use the cash. But we also have growth options open for us. We will be on the drawing board of 1.35 million ton and 1.5 million ton. With the current cash flows that I am talking about, 10,000 crores or even slightly more than that, the whatever net debt we have with that also can be wiped out. So I don't see any difficulty in the balance sheet for this company to grow further, whether it is organic or inorganic investment. And of course, remunerating shareholders is a decision of the board. We will leave it to that.
Mr. Mishra, last year what stood out was the big dividend payout. So that's why, my colleague asked you on that front. So let's see how that one goes, because you'll have to wait between capex as well as growth. Final question then, what's the update on the government of India selling its near 30% stake in HZL? We've been asking you this for the last few quarters. Any update? Is there an OFS in the books?
No, government of India is on the job, and as far as whatever little I know of, they are looking at the right time for doing it. You must have observed our current stock exchange went through a lot of turmoil in the last few months. And at this point, entering the market with 48,000 crore kind of an offer for 30% stake that they have, perhaps the market would not have the capacity to absorb. So right timing is needed, right quantum has to be decided so that, the market can absorb that.
Sir, appreciate your thoughts. Thanks a lot for joining in and speaking to CNBC-TV18. Let's do one thing. Let us take a quick break. The market has, by the way, given up all of its gains. And this is disappointing, given that we had strong cues to wake up to ICICI Bank and Reliance. The market has not latched on to that. But let's do one thing. Let's take a break. On the other side, a special segment, Quarter Se Quarter Tak. Sonal will join in. She will give us a brief on what one can expect from the chemical space in Q4. We'll also have a chat with Rohan Gupta of Nuvama Institutional Equities to take that discussion forward. Stay with us.
For March 2023, the credit card spends grew by 28.2% YOY and about 15.7% on a month-on-month basis to more than 1,35,000 crore. While monthly spends are the highest ever for the credit card sector, the credit card issuances also have remained healthy as always. So in March 2023, the credit card issuances grew by 2.3% month-on-month and about nearly 16% on a YOY basis. Card issuance growth is the best in last 9 months. Average spends was at about 16,143 rupees, which is up 10.6% YOY and about 13% on a month-on-month basis. So average spends are the second highest that you are seeing post Diwali. Let's look at the top 4 performance. So performance for March, now with cities number being in the
Okay, welcome back. The market is up just about 22 points or so, and things are looking, way off the highs of the day. Some almost 75 points away from the opening level is what we have, and we've been trading for about 40 odd minutes or so. Now, time for our segment, Quarter Se Quarter Tak. Sonal is standing by on the big wall. She brings us expectations from the chemical space in the fourth quarter. Sonal, over to you.
Thank you so much for that. Well, every chemical company has a different fundamental and factors affecting individual performance. But overall, for the chemical industry, it is largely expected to have to see an improvement on a quarter-on-quarter basis due to pickup in exports this time. But there could be a muted performance YOY in some cases due to weak global demand environment in terms of raw material costs. Basic chemicals, they have seen a decline in prices as crude prices, they have fallen 8% on a sequential basis. For oleochemicals, it is down 20% on a sequential basis. We have seen ocean freight costs which are down anywhere between 40 to 50%. But demand pressures will continue in discretionary sectors like dyes and pigments, polymers, etc., something that companies have indicated to us. In the fluorochemical space, sustained high price in refrigerant gases will aid earnings. However, there will be weakness in packaging and textiles business. This is for SRF in particular. And that's why revenue will be flat. EBITDA and profits will be down for the company. However, for Navin Fluorine, earnings will be aided by improvement in high-performance products and specialty chemicals segment, leading to a 56% revenue, 98% EBITDA, and 52% profit after tax growth. For Aarti Industry, which recently saw demerger of the pharma business, we will not be able to compare numbers YOY due to the demerger, but incremental revenue from new capex is expected only in FY24. And that's why revenue is flat in Q4. EBITDA will be expected to go higher by 2%, but profit after tax is expected to decline 2%. For oleochemicals player Galaxy Surfactants, it will be a steady performance after some weakness that we have seen. Volumes are expected to grow 6%, out of which performance surfactants will do well, up 10%, but specialty, which is the high margin product, will be flat. For Jubilant Ingrevia, operational metrics will be weak, down between 11 to 15%. This is, of course, on a high base. Acetic acid, which is the key raw material, has seen a 40% decline in pricing, which will lead to lower revenue as well. Generally, active ingredients saw a decline, and that's why performance will be weak. Now, taking you through the stock moves this year and valuations as well, barring few, these stocks have underperformed. So, SRF, Navin Fluorine, they have been up anywhere between 8 to 16%. Valuations for Navin Fluorine are way higher at 45 times. Galaxy Surfactants is up 3.5% with valuations around 23 times. Aarti Industries is comparatively is also on the lower side. If we talk about the newer listings, Tattvachintan, Clean Science, Chemplast, all are down between 7 to 23%, and valuations are ranging anywhere from 13.5 times for Chemplast to 40 times for Clean Science.
All right. Thanks very much, Sonal, for that. Appreciate it. That's chemicals, and you know, as Sonal correctly pointed out, this is a very varied space, and the drivers and the earnings drivers for every company pretty much is very different. So while we say it's all chemicals, it is chemicals, but they're very different chemicals. Just a few other names in the market before I bring in our guest who's going to tell us what he likes in the chemical space ahead of the earnings. HBL Power, I highlighted this in the morning. It's up a full 8% on very large volumes, by the way, HBL Power. I think on Friday as well, it saw a very large move. And this morning, it's seeing, you know, a pretty significant kind of move as well. It's from 98 levels, stocks moved up to about 120 odd levels right now. I can spot Ircon, which is showing about a 5% pop. Borosil Renewables is having a good day, and it's had a pretty decent last 3 days now. JBM Auto is another one which is up 3. Mirza International, of course, we've been highlighting. Engineers India Limited is up about 4.5%. And then, you know, down the list, there are more names, but not backed by too much by way of volumes at this point in time. On the downside, Sun Pharma has seen a full reversal. It's down 2% as the largest volume-led loser at about 968. And then you've got Yes Bank. The management of Yes Bank joins us in a bit from now, 15-16 rupees in Yes Bank. ICICI Pru, Dr. Reddy's, Laurus Laboratories, PVR are some of the stocks on the downside. Delivery is down, Crompton is down, Max Healthcare is down, and Hindustan Zinc is down about 2.25% as well. So that's the market picture for you, Sonia.
Absolutely. And you know, one space which is looking good this morning is two-wheelers. I'll tell you why. Bajaj Auto is actually at a fresh 52-week high. It comes out with numbers tomorrow. The expectation is that numbers could be decent this time around. So there's TVS Motor, Hero MotoCorp, and a lot of the auto ancillaries that supply to the two-wheeler space, Endurance, for example, that are just up and about, expecting perhaps decent set of numbers. But let's get back to the specialty chemical space. We have Rohan Gupta, director at Nuvama Institutional Equities, who joins us now. He tracks the space very closely. Rohan, thanks for being with us on the show. You know, good to have you. Tell us a little bit about what you're expecting. Which are the companies that could do well? Which are the companies that could take a back seat?
Hey Sonia, hi, good morning. Yes, so specialty chemical sector, our view is that the current quarter should see some kind of improvement what it was in a Q3. If you see that the sector has definitely been under slight pressure from last 2 quarters. It was also basically coming from a very high base of last year. But we expect that the overall demand scenario has been pretty decent and it has been continuously improving. Raw material prices have stabilized somewhere, and that's what is going to drive the margins of most of these companies going forward. So maybe a little bit weakness in the current quarter, company specific, but overall our view on the sector is very positive. I believe that from Q1 to Q2, there should be continuous improvement across the chemical sector.
Hi, Rohan. Good morning. Like the new look as well, Rohan. What about, where could we see a positive surprise coming in? If I'm looking at Q4, which could be a couple of those companies that we should be keeping an eye out from, or some kind of commodity that we should look forward to?
Thanks, Nigel, for the comment on my new look. So I think that the market, the way it is changing, we should also keep changing ourselves. So yes, so I believe that yes, there is a couple of companies, especially in fluorination chemistry. I understand that the numbers are likely to remain positive. Companies like Navin Fluorine, SRF, these are the companies including Gujarat Fluoro. I understand that these companies will continue to have a positive impact on as far as the results are concerned. Even if you see that the demand scenario for fluorine chemistry, especially coming from the air conditioning industry, remains very positive. We are expecting a huge, quite a wide summer that is also going to drive the demand growth for refrigerant gases. So as far as the fluorine is concerned, I think that the overall demand scenario is likely to remain positive. Also, companies catering to agrochemical intermediates, we see that have not been impacted in the current quarter, companies like PI industry. So these are the companies we understand that will continue to have a decent result. However, some of the commodities nature of the companies like Aarti Industries, Jubilant Ingrevia, Deepak Nitrate, some of these companies may have slight pressure because of the way the RM prices in these commodities has been falling, and there can be some low impact on the margins also on these companies.
So these companies, right, Rohan, whether it's Jubilant Ingrevia, whether it's something like an Aarti Industries or even Tattva Chintan Pharma, these are stocks that have had deep cuts this year. I mean, over 20-25% falls in 2023 already. Do you see more pressure stock-wise because of the fact that earnings may not improve as much?
So yes, some of these companies have definitely seen a sharp correction. The reason being has been mainly this company was also trading at a very high valuations. There, I think that the valuation correction is over now. As far as the earnings corrections are concerned, I think that the earnings cut is all broadly done. And as I just mentioned in the starting of the conversation, I expect the second half of FY24 is something where we should be seeing the improvement in earnings of all these companies. Also on a low base of this last year, I think the earnings growth will be pretty decent for second half of most of these companies.
All right, we leave it at that, Rohan. Thanks a lot for stopping by and speaking to CNBC-TV18. Appreciate your thoughts. That's on the specialty chemical space. What you can expect. The market, by the way, has given up all of its gains of the early morning. So it's barely a few stocks that are holding up in the green now. On the downside, it's pharma that's getting hit quite a bit. Sun Pharma, Dr. Reddy's, Cipla, all your top losers right now. Let's do one thing. Let us take a quick break. On the other side, Mitesh Thakkar will join in for some technical trades.
For March 2023, the credit card spends grew by 28.2% YOY and about 15.7% on a month-on-month basis to more than 1,35,000 crore. While monthly spends are the highest ever for the credit card sector, the credit card issuances also have remained healthy as always. So in March 2023, the credit card issuances grew by 2.3% month-on-month and about nearly 16% on a YOY basis. Card issuance growth is the best in last 9 months. Average spends was at about 16,143 rupees, which is up 10.6% YOY and about 13% on a month-on-month basis. So average spends are the second highest that you are seeing post Diwali. Let's look at the top 4 performance. So performance for March, now with Citi's number being in the Axis details, a card market share for the top 4 has risen to 71.37% when compared to 68% in the previous month. Spends market share is at 74.74% for the month of March versus 71.9% on a month-on-month basis. Remember that Axis Bank's numbers now have Citi's numbers as well in March. So spends market share in spends is at 12% for Axis Bank versus 9% month-on-month, a gain of nearly about 300 basis points, while credit card issuances market share for Axis Bank now is at 14.2% versus 11.5% on a month-on-month basis, a gain of more than 270 basis points month-on-month. So in the top 4, due to Citi acquisition, Axis Bank has gained market share in spends by about 321 basis points. Ex-Citi, Axis Bank would have gained market share by 24 basis points. HDFC Bank has gained market share by almost 82 basis points to 27.4%. The top loser is ICICI Bank by about 189 basis points. Now the market share is 17.4%, and for SBI, the loss is...
Welcome back. Well, there's nothing really to report except that the market is very quiet. The banks are actually batting for the bulls. The bank Nifty is up about 200 points, led largely by ICICI Bank, but it's unable to do much for the overall index. So while ICICI Bank is holding up, SBI, IndusInd Bank comes out with numbers today, so that's holding up. It's really not taking the headline index anywhere. That's perhaps because other heavyweights like ITC, TCS, Kotak, L&T, Bharti are all under a bit of pressure. Mitesh Thakkar is joining us now to tell us how to approach the rest of the day. Mitesh, for this week, any thoughts? I mean, will the market break out of the range, or are we just going to be ambling around these levels? And for the rest of the day, what are the stocks you're looking at?
So I believe that there could be another couple of days of consolidation left, but I think there's still a possibility for breakout happening. The only downside to it is that we start trading below 17,550. So till that happens, stay positive. On the stocks, and also with that approach, we have more long calls. In fact, at the sometime during the show, you were talking about Bajaj Auto. That features on the list. It's been a buy earlier as well, but now can be bought afresh. Keep a stop below 42.90 here. Look for targets of around 4,500. 4,410 on the upside. And the other stock is Canfin Home Finance. That's kind of giving a good reversal on the hourly chart. So buy here with a stop at 564. Look for targets of around 585 to about.
Okay, all right. Mitesh, I'm not sure whether you tracked this one. HLE Glasscoat, the stock is up close to around 20% in this month. From the peak, it had half though. Anything on the charts that you could tell us? HLE Glasscoat, and volumes are rather large as well.
No, I'm not been tracking. Sorry, just don't have any idea.
Okay, all right. Just was tracking that one from the peak. If you pull up a 1-year chart, it's still half of what it was at its peak. Maybe input cost cooling off. That could help margins go back to those high teens, which had fallen to low teens, still down 40% in the last 1 month. Well, let's move on then. ICICI Bank reported a strong set of numbers in the fourth quarter earnings. That was aided by strong net interest margins as well as higher operating profit. Let's listen in to what the bank's MD and CEO, Mr. Sandeep Bakshi, had to say on the bank's super performance.
Including non-fund based outstanding, the retail portfolio was 45.7% of the total portfolio. The business banking portfolio grew by 34.9% year-on-year and 7.8% sequentially. The SME portfolio grew by 19.2% year-on-year and 6.2% sequentially. The growth in SME and business banking portfolios was driven by leveraging our branch network and digital offerings such as InstaBiz and Merchant Stack. The domestic loan portfolio grew by 20.5% year-on-year and 5% sequentially. The overall loan portfolio grew by 18.7% year-on-year and 4.7% sequentially. Looking ahead, we see many opportunities to drive growth in the risk-calibrated core operating profits. We believe our focus on customer 360, extensive franchise and synergy and collaboration within the organization, backed by our digital offerings and process improvement and service delivery initiatives, will enable us to deliver customized solutions to customers in a seamless manner and grow market share across key segments. We will continue to make investments in technology, people, distribution, and building our brand.
Okay, well, that is the ICICI Bank chief with some detail. Well, numbers have been solid. Now, Sun Pharma, the stock is now slumping. It's down about 2.25% on large volumes. Ekta is here with the news flow behind it. Ekta.
Thanks for that. Well, yes, it is negative news flow, which is coming for some today, over the weekend rather. They have received a letter from the US drug regulator for their Mohali facility, which is located in Punjab. The letter is titled a consent decree correspondence. Remember that the consent decree was issued during Ranbaxy's time. This is a Ranbaxy plant, and that was issued in 2012. And / a non-compliance letter. That's basically what's been issued by the US drug regulator. Now, the background is that the US FDA had inspected this particular plant in August of last year, and at that point in time was issued 6 observations. It was eventually classified as an official action indicated status by the US drug regulator. Now, basically, this is a non-compliance letter, so the Sun Pharma has indicated that they have to take certain corrective actions before releasing final product batches into the US, and the actions could include retaining a current good manufacturing practice expert to conduct batch certifications before they are compliant with the US FDA standards, and hence they can restart operations or shipments from this plant. Now, the temporary pause in release of the batches from the facility could possibly run into 3 to 6 months according to brokers, but the impact financially is expected to be limited to maybe low single digits or just about marginal. Now, however, the street is not worried about that. They are worried about the larger compliance issue that Sun Pharma is probably facing at this point in time. They are just questioning, whether or not there is a company-wide issue that they need to actually look at. And the reason being that Halol plant was also issued an import alert just last year, which was in December of 2022. So this, combined with the fact that the Mohali facility has, according to brokers, just been stopped short of issuing an import alert, makes it an issue that they need to look at on a larger scale. So that's what seems to be worrying the plant, worrying the stock, not an isolated incident on Mohali as of now. But what is possibly going to cushion them is the specialty sales of Sun Pharma, which are strong, and hence the street would probably be bullish on that factor and maybe eventually brush off these US FDA concerns as well.
Okay, Ekta, thanks a lot for that. So that's on Sun Pharma, one of the big movers at the moment. The other stocks that we are looking at right now, ITC, by the way, is taking a bit of a backseat, so that's down almost about 1%. The market has now moved completely, emphatically into the red. So it's lost all of its volumes and it's lost all of its price action from the early morning trade. Yes Bank is the stock that is under a bit of pressure, down about 2.5%. I think the reason for that is that the asset quality has deteriorated. So that's something that the street doesn't like. Remember, at a time when most banks are doing, reporting record quarters, record margins, Yes Bank has actually seen a deterioration of asset quality. Their gross NPAs have risen quarter on quarter, and that's something that the street just does not like. They've also lost market share on a year-on-year basis. So Yes Bank is now back to becoming, I think, a 15 rupees stock. A couple of other stocks, Vodafone Idea, Z Entertainment, Bajaj Hindustan are also in the red right now, down almost about 1 to 2.5%. So market is losing its focus a little bit.
Absolutely. I mean, down and looking a little under pressure now in the red. Now, Yes Bank had reported numbers. It was a weak quarter for Yes Bank as their asset quality deteriorated. Their net interest margin is, though, the best in 9 quarters versus expectations of a decline, which had been there earlier. Bank's return ratios are poor in the 4th quarter, while it has also lost market share. for the year. Prashant Kumar is Managing Director and CEO at Yes Bank, and he's joining us right now to take some questions and discuss the numbers with us. Mr. Kumar, good to have you with us here. Thank you very much for your time. Can we start with the asset quality question, sir? What happened in the quarter gone by? What is the outlook at this point in time? What should we build in really in F524?
So basically on the asset quality, if you see our slippages are 25% lower as compared to the last quarter. And the gross NPA, which used to be in the range of 14-15%, currently is 2.2%. But sequentially, yes, it has moved from 2% to 2.2%. And fundamentally because of technical things, there were certain accounts which were under the COVID restructuring, and they are performing assets. But as per the Kamath Committee regulations, if those entities do not meet the financial ratios as on a particular date, like 30th September 22, they have to be technically downgraded to NPAs. So I think that was the only thing. Otherwise, we have been able to protect our asset quality. And if you see the net NPA has come down to below 1%. It's a 0.8%. And I think if we see the history of Yes Bank, this is one of the best. And even in terms of net assets as well as net carrying value of security receipt has come down from 4.8% as on March 22 to 2.4%.
All right. Hi, Mr. Kumar. Good morning. So you expect asset quality to get better from here, right? That's a sum and substance.
Absolutely. Because in the FY24, the slippages would be somewhere between 1 to 1.5%.
Got it. All right. Let's move on then. Your loan growth, you're guiding for around 15 to around 20%. Retail as a percentage of your book has gone up. In the last few years, going by your presentation itself, in the mid-20s, it's gone to mid-30s. Now it's at the mid-40s. So you're expecting that vertical clearly to outgrow what the overall business will grow at. Where do you see this number stabilizing in terms of retail contribution? And more importantly, if you could tell us, Mr. Kumar, what about the NIMs? From around this 2.8%, which is looking quite good, the street is working with it skimming down a little bit. To what levels?
No, in terms of retail contribution to our loan asset, already like 45%, but retail is growing much faster than the corporate. So even the last year growth has been 38%. I think this trajectory would continue for some time, and retail would be somewhere around 50% of our balance sheet. Regarding the NIMs, I think we are still in that trajectory where for us this is not peaking out. This would be a continuous upward journey for us. And the real contribution is coming not only from better yield on the loans, but also in terms of our deposit costs. If you see like the average CASA deposit has grown by 26% last year, and the average current account has grown by 30%. Today, like our CASA ratio is 31%, and the 50% contribution is coming from current account alone. I think this trajectory would continue to improve, and we would be seeing a upward improvement in our NIMs.
What level, sir? Could you give us a number?
Sorry, can you again say?
Could you give us a number? You're expecting NIMs to improve to what levels? Give us a broad range.
No, number I would not be saying, because the reason is you need to be cognizant about what is happening in the market in terms of interest rate scenario. But I think the way it is inching up, it would continue to have this upward trajectory going forward.
Okay. Upward trajectory going forward. I think, what the street is really disappointed with, Mr. Prashant, is that you're losing market share in the loan space as well. Now it's at about less than 1.5%, and this at a time when there is so much competition, not just from traditional banks, but from fintech companies, etc. Wanted to understand, is there more market share loss that one can expect, or do you think there is an improvement over there? And also, on your cost to income ratio, it's one of the worst in the industry right now. Can you explain to us at a time when, private sector banks are seeing a big up move, yours really is there's a lot left to be desired in terms of these internals. Any recovery that we can expect?
No, if you see in terms of our market share on the loans, And if you compare with the previous years in terms of 2020-21, every year there has been a improvement in our market share on the loans. Overall, if you see, it's a almost 13% loan growth, but retail is growing 38%, MSME around 22%, mid-market is also growing 36%. So it was a very strategic call to reduce our large loan part, which has already peaked out, I would be saying. And next year, 15 to 20% growth would further improve our market share. So I'm not saying our market share has come down, it has actually gone up. Okay? In terms of cost to income ratio, I think what we need to also appreciate, this was like a strategic shift in the bank last 3 years. We are making it more granular, more retailization of the bank. And whenever you go into this journey, there is always a higher cost. But even with this granular retailization of balance sheet, we have been able to protect our PPOP2 assets. And now there is a time where we have reached to that inflection point where the cost to income ratio would also start improving and would giving us the higher NII and also to have a control on the cost.
Well, Mr. Kumar, we've got your operational performance. Is there any additional provisions that need to be made because of the pending A1 matter in courts? Is there any pending provision or it's all been done?
No, so not required. So to be very frank, I think the write down of 81 has been done strictly in accordance with the regulation and Basel regulation. Okay. And now since the matter is now pending with the Honorable Supreme Court, so we'll take a call after that is decided.
So as of now, no additional provision needs to be made on the back of that front.
Right.
Yeah. Okay, got it. With regard to your shareholding as well, you had a couple of the large shareholders, banking names, who have stake in the shareholding, and that cooling off period expired a month or so ago. Anything you've heard from them? Because that's what's causing the stock market to be a little bit jittery. Will there be some large supply that will come in there? Anything you have picked up from the buying or from the selling side?
No, if you see the movement, we analyze it every day. So I think after the lock-in on 13th March was over, so all our large investors have not sold a single share. That gives us quite confidence to us. Yeah.
But are they looking to sell? Have you heard anything?
No, we have not heard anything. They would be in the best position to respond to that. But we have not heard.
Have they communicated that they don't want to sell in the near future, at least, Mr. Kumar? I ask you this because besides the operational performance, all the other metrics that we discussed, but this is a bit of an overhang. So any communication from them or no communication whatsoever as of now?
No communication. But if you see like what happened in, say, more than 1 month, so actually there has not been anything.
All right, Mr. Kumar, thank you very much for your time. Good speaking with you. Appreciate you joining in with all of that. Good luck to you, sir, and the business. And we hope to speak with you soon again. I mean, the market is once again pretty much similar to what we've had now for the last so many days, which is nothing, which is absolutely flat in the index once again. Half a point change. I mean, this is as flat as the market can get with a full 1 hour of trade behind us. 17,623 is where the Nifty is trading at. Market breadth is still positive, though it's just about 300 odd stocks which separate gainers and losers right now. 1,200 stocks are higher, and you've got about 950 stocks which are lower at this point in time. So that's the market action for you. So far, I mean, there was a bit of a flourish right in the word go, but that's been long sold into, and we've got not very much, at least on the indices. Maybe just a quick look at the Nifty bank that is doing better. And I was saying this in the morning that there is a clear divergence with banks doing much better as compared to the Nifty. That index is up 0.5%, thanks, of course, to names like ICICI, etc. And the mid-cap and the small-cap indices also, maybe mid-cap index is absolutely flat, and you've got the small-cap index, which is actually up 0.5% or so. So small cap index is not doing all that badly. And I guess that explains the advances to declines ratio, which is still very positive. We'll take a break. On the other side, Manisha will put the focus on commodity markets. What's top of mind there? Stay tuned. Coming up.
सदियों से चुप बैठी आज मुंह खोलूंगी तोड़ के दरवाजे सारे आज सच मैं बोलूंगी सहनशीलता को मेरी कमजोरी ना समझो तुम.
It's rare to see a 12-year-old speak about gender stereotypes, but for Swati, it's normal. She and her classmates have been part of Slam Out Loud's Jijivisha program for the last 8 months. And for them, such performances are a learning experience that teaches life skills and awareness around cultural and social issues. Swati is among around 12,000 children from disadvantaged communities across 5 Indian states who are learning creative confidence skills under Slam Out Loud's unique program that uses performance and visual arts to build socio-emotional learning skills.
For children who come from low-income backgrounds, all we do is restrict what we do with them to either academics or at best getting a job. And I thought somebody should be doing something about these children.
But what led to this idea?
One day I actually landed up in Kashmir, and when I walked into that class, I was doing this workshop. I asked children to pick an emotion and write a small poem on that emotion. And most children, like about 30 out of 35 children in that classroom, ended up writing about emotions of anger, confusion, sadness, hate, feelings of isolation. And I think on that particular day, I did not have a response to that as a teacher.
For Labru, the response is still not complete, but it's gaining form. We are here at the Vikas Valley Public School in Delhi's Uttam Nagar area, where Slam Out Loud has been conducting the Jijivisha Fellowship for a year. The fellowship places artists into the classroom of low income.
Well, this is a really sideways market, so nothing can get it out of its slumber, so to speak. The Nifty is not doing much at all. It's just HDFC Life, which is up almost about 5% Couple of stocks like Cyient continue to pile on the gains after the very positive commentary that Cyient made last week. The stock is up another 4%, which means it's a 50% gain this year already. And then, some of these capital goods names are looking good. So ABB India is in the green. L&T was holding up, but let's see how that's shaping up. And something like a Paytm, SBI Card, Bandhan Bank, and a couple of other stocks that are holding up in the green right now. So lots of individual stocks to track, but the headline index is really not doing too much. So it gives us some time to ponder over the commodity markets. Manisha Gupta is joining in. Manisha, what's the one commodity that you're looking at today?
Sonia, I'm looking at metal as a sector, which hasn't started this week on a positive note, and you will see that impact coming in for many of those metal stocks as well. So we are starting with a bit of red into the street there. The PMI data from across world has come in on the positive side, and that tells you that the rate hike concerns just become more concrete right now. What the street, though, will be watching out for is the first quarter GDP numbers from the US markets that come in on this week itself. I'll start with the steel prices, which are trading at a 4-month lows right now, trading below $3,800 a ton there. We have seen Chinese steel demand decline by 19% in the first quarter of year-on-year from the construction season, and that is weighing onto the markets. Apart from that, when you look at the Chinese steel production numbers, that actually have gained up. For the month of March, nearly 7% up, and for the first quarter, up by nearly 6%, and the consumption has declined, and that's clearly weighing onto the steel prices there. I also want to talk about the copper prices, where we are trading at a 1-week lows on your screens. 19% of a decline in imports is what we've seen in the month of March. So the demand clearly was on the weaker side there. And the premiums have continued to decline, down by nearly 27% since the start of 2023, tells you that the demand in China clearly is quite uneven, fragile even. LME stocks are trading at the lowest in 2005, but when you look at the Shanghai stocks, they have started to see a bit of a drawdown in the month of April, and that also has slowed down. The rising production in Latin America also continues to weigh in case of copper prices there. And then take a look at iron ore prices. That's trading at a more than 3-month lows into the international markets. The Chinese markets have seen a very sharp decline, and the producers like Rio Tinto and Vale have seen production increase for the month of March and for the first quarter as well. The China State Planner in the meanwhile have said that they are keeping an eye on the price dynamics here, and any manipulation will not be allowed. So we are looking at iron ore prices getting stuck in a very narrow range there. If you look at the zinc prices, they are trading at a 5-month lows, aluminum prices trading at a 1-week lows, and this is what we've done in the last 1 week when it comes to many of these metal prices. The sharpest of declines coming in from steel and then iron ore. You also have seen the zinc prices decline by 5% in last 1 week. Also trading in the green is copper. Aluminum actually is the only one that's trading in the green. We have seen 1% 0.5% gains right now, and the prices also have opened Asian markets nearly 0.5% on the higher side.
All right, Manisha, thanks very much for that. That's commodities in focus. RVNL is up 7%. Actually, these rail infra stocks are, I want to put out three names. RVNL is up 7%, 83. IRCON is up 8%, and IRFC is up 5%. So these are three big buzzers right now from the rail infra, rail financing space, but railways largely, which is in focus. Surya Roshni is up about 5% or so right now. HBL Power, of course, I've been highlighting. It's come off, actually, cooled off a little bit from the high point of the day. Cyient had reported very good set of numbers, and it reacted very well on Friday, although it did cool off from the day's high that day. But it's up another 4% this morning. Cyient, that's largely, what's doing very, very well. More on the more stocks on the which are moving, perhaps a few on the downside. PVR is down about 1.7. The Adani Group stocks, Green and Power are both down about 3 and 2% each. And you've got Piramal Pharma. It had a bit of a good day. I think Thursday or Friday it was up in a big way, but it's starting to slump once again. I think it was Thursday where Piramal Pharma saw a big move. Friday it slumped, and today it's giving back some more of those gains. On the Nifty, it's just about 7 or 8 points, all said and done. From all of us here on the Bazaar team, goodbye. Thank you very much for staying with us. Chartbusters is coming up next.
Walk along the streets of Kiev, of Kherson, of Kharkiv, and not a lot of people have a lot to say. Well, in Kherson, there's nobody around to say anything. In many parts of Kharkiv, there's nobody around to say anything on the streets. But war is on everyone's mind. How do you read that? Read it on the walls, on the paintings, the figures, the graffiti, the posters. Some people have said it there, others are seeing it there. Let's hear some of what Ukraine is saying without actually, of course, saying it. By the Krishatik Street in Kiev, a row of posters remind passers-by of their Ukrainian past, as distinguished always now from a Soviet and particularly Russian past. Along the Freedom Square in Kharkiv, the word is out: keep calm and win. We will rule the cosmos. What is a marvel? It is the armed forces of Ukraine. Kharkiv is the hero city. Its people stand together. Everywhere, the walls speak their tribute to the fallen. A flag for every fallen soldier, but that was at the start of the war. There is no room for many more flags here at the Maidan in Kiev. The plaques are long out of date. Updating them is just too difficult. The call to arms, the call to back the armed, speaks on every street. An SOS for ammunition, cry against war, a salute to miraculous HIMARS missiles, and a loaded recall of a poem. Lovely maidens fall in love, but not with Muscovites. Remnants of old wars stand here and there. Preparation for the war underway is everywhere. While there is a chance, fight to the end. Don't be afraid when you're alone. Be afraid when you know more. Statues and monuments now stand a shrouded tribute to the dead. In Ukraine today, Christ himself appears in a bunker.
सदियों से चुप बैठी आज मुंह खोलूंगी तोड़ के दरवाजे सारे आज सच मैं बोलूंगी सहनशीलता को मेरी कमजोरी ना समझो तुम.
It's rare to see a 12-year-old speak about gender stereotypes, but for Swati, it's normal. She and her classmates have been part of Slam Out Loud's Jijivisha program for the last 8 months, and for them, such performances are a learning experience that teaches life skills and awareness around cultural and social issues. Swati is among around 12,000 children from disadvantaged communities across 5 Indian states who are learning creative confidence skills under Slam Out Loud's unique program that uses performance and visual arts to build socio-emotional learning skills.
For children who come from low-income backgrounds, all we do is restrict what we do with them to either academics or at best getting a job. And I thought somebody should be doing something about these children.
But what led to this idea?
One day I actually landed up in Kashmir, and when I walked into that class, I was doing this workshop. I asked children to pick an emotion and write a small poem on that emotion. And most children, like about 30 out of 35 children in that classroom, ended up writing about emotions of anger, confusion, sadness, hate, feelings of isolation. And I think on that particular day, I did not have a response to that as a teacher.
For Labru, the response is still not complete, but it's gaining form.
We are here at the Vikas Valley Public School in Delhi's Uttam Nagar area, where Slam Out Loud has been conducting the Jijivisha Fellowship for a year. The fellowship places artists into the classroom of low-income schools. Slam Out Loud in-person programs serve around 12,000 disadvantaged children across India and 5 million children globally through their online programs.
The going has not been easy because for so many schools catering to children from low-income households,
the RBI allows HDFC Bank to raise stake in insurance subsidiaries ahead of its merger with HDFC. HDFC Life surges as the threat of 19% stake sale by the merged entity now fades.
Reliance delivers a very strong showing in the fourth quarter with an all-round beat on estimates. A strong showing from the oil to gas to chemicals business drives record quarterly profit, while margins expand as well.
ICICI Bank reports record net interest margin and return ratios in the fourth quarter, while gross and net NPA ratios hit 33-quarter lows.
The US FDA issues a non-compliance letter for Sun Pharma's Mohali unit, causing a temporary pause in product releases. Brokerage house InCred expects a short-term mid-single-digit impact on the revenues. Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me as always is Mangla Malu. Well, we have earnings that are coming in thick and fast. So let's move and focus on earnings itself since the markets are more or less unmoved. So our first guest on the show is MapMyIndia. They reported a pretty good set of numbers in the past quarter. Let's welcome Mr. Rohan Verma, who is the CEO and Executive Director of the company. Hi, Rohan. Morning. Thanks so much for joining in. Well, let's get straight to the numbers. Last year, you've grown close to around 40% or thereabouts. What's the growth trajectory you're looking at for this year? If you could give us the consolidated number, point number one, split it up vertical wise, and G Trophy, how much did it contribute last year? How much will it contribute in the coming year?
Sure. Thanks a lot for having me. Definitely, I think we'll grow faster than what we grew last year. Our open order book, as you see, has gone up to 918 crores. So I think that's really good. We've also added 250 plus new customers, growing from 600 plus to 850 plus. And so obviously those revenues from them will also start kicking in. Not all of it is reflected in our open order book. And if you look at the IoT business, it actually has grown 140%. And even the margin is starting to increase. As you know, it's a low margin business in the beginning because it's hardware led, but the SaaS income starts kicking in and so margins increase. So in the last quarter, the margin increased for that IoT business. So that's a good sign that our investment is reaping good benefits. But even outside of our IoT business, our map-led business, which obviously has very, very high margin for 52% odd and is majority of our business today, that also will grow, whether in automotive or corporate or government.
Right. Rohan, we understand, the way things have happened in the last year. You've detailed those numbers in your press release as well as through the exchanges. What we want to know is what rate can you grow at in FY24? Yeah. And the reason why I ask you this is because I'm just looking at your revenues over the last 5 years. They've been pretty sporadic. Last 2 years, we've seen 30% sort of growth. What's a sustainable path? And in that, how do the verticals stack up?
Sure. That's what I was trying to say, that, more than 40% last year, it will be more than 40% this year. And, the revenue growth is a function of the open order book. And as you can see, our open order book has been surging from 377 3 years ago to 699 to now 918. So that's a good reflector for kind of where revenue will grow. And hence earlier it used to grow smaller, and the absolute growth has been growing further year on year. Again, automotive, super excited about all the new generation of EV platforms which are going mainstream in the four-wheeler. Two-wheelers are really taking up our NK solutions as well, and so are commercial vehicles, both new vehicles going built in, as well as, this base of 20 crore plus vehicles that exist on the road. So just for numbers, 1.9 million new vehicles went built in versus 1.3 million. So that's 46%. We estimate more to happen in this year. And 2 lakh devices sold to existing vehicles through our IoT business, and versus 60,000 the year before. And there's 20 crore plus vehicles on the road. So huge opportunities ahead on A&M and IoT in general, which we're quite excited about. And on consumer tech and enterprise digital transformation, geospatial, drones, where we are strong on each of these categories. We are the market leader, and so we foresee pretty strong growth, whether in the private sector or public sector going. So yeah, just in short, 40% plus across categories.
40% growth out there. The 1.3 million units became 1.9 million units. You said you'll do better, but you stopped short of giving us a number. Where do you see that number at? And also the margin band has been quite wide for a long while now, 35 to 45%. Narrow down a little bit, right? For FY24 on an average, what can you do?
See, I guess I tried to kind of stay on the conservative side, and I guess we've done 40% plus margins also consistently. We are trying to invest for growth. As you see, we're trying to increase visibility and reach of Mappls, MapMyIndia as a brand, our consumer app, Mappls app, and our consumer gadgets, Mappls Gadgets. That has a strong knock-on effect on our B2B business as well, besides the B2C opportunity being large in its own right. EBITDA margins you can expect to be 40% plus over the course of the year. I'm not going to get into quarterly because
that works well. And also the number of units, as you said, 40%, 1.3 became 1.9.
It's a little bit. That's a little bit function of kind of how new vehicle sales pans out in the year. But we can't control how many cars or two-wheelers get manufactured. But obviously, our uptake in that is increasing, and so we've grown faster than industry growth. Plus, we are also going after the existing vehicles on the road. So in general, we're quite bullish on number of vehicles that will go. I don't want to give a number right now because a little bit we're dependent in that on how the automotive industry or market does.
All right, just a couple of questions, Rohan. One is you said that you are looking to increase your marketing spends and awareness, etc. In the fourth quarter, your marketing spends were lower. Was this a conscious decision? I mean, are you looking to, increase it in FY24? If yes, so what proportion of sales are you targeting as marketing expenditure? And the second one, on your order book itself, you said the open order book is around 900 plus crores. Plus, there is a lot which is not reflected in the open order book. So if you could add that as well and give us the potential order book that the company could have and break that up from, various verticals, auto, consumer tech, defense, drones, all these things that you've been talking about. So one is on marketing spends. The second is a detailed look into your order book.
See, marketing spends are a function of one is calibrating in the fiscal discipline or fiscal rails that we set for ourselves. And also it's a function of when we want to go about doing it. There's a right time to do marketing spends for us. So in a sense, you can think that we've been building up, and definitely we'll spend more on marketing. But as a percentage of sales, I don't think, I mean, there will be a difference, but it'll be within the realm of what our growth in profits and growth in revenue is. So again, stopping short of giving some exact numbers because we want to maintain that, ability to calibrate up or down. And the second is what you said on a potential order book. There's a lot of rate contracts or subscriptions that we sign, where it's dependent on how much consumption the customer will do. And hence, because it's not contracted or we are not assured it, we don't reflect that in our open order book. Open order book is a reflection of what we really believe contractually that we will get. So that's why I mentioned that 250 plus customers added, and also a lot of existing customers who are on kind of pay-as-you-use models. So again, it's hard to estimate that, and really no point. That's why, every year revenue is a function of both, based on open order, but also based on consumption in year. So
two solid numbers that we've got is 40% growth at least, with margins of more than 40% on average. So those two, we're thanking our stars for that. But what about G Trophy? As a percentage of your total open order book, how much is on G Trophy? And just coming back to what was the contribution of G Trophy? I mean, what did you end FY23 with on G Trophy itself?
Yeah, so G Trophy, we correlate G Trophy to our IoT-led business, because primarily G Trophy is our IoT-led business. There's a little bit of IoT-led business that MapmyIndia also does. So if you see the overall, I think 280 crore, about 60 crore came from IoT-led. And remember, G Trophy is not really inorganic. We paid 13 crores to acquire a team of 125 and a revenue of 8 crores. I think growing that, and MapmyIndia itself had a 25 crore IoT business. So it's grown 140%, but a lot of it is to do with MapmyIndia's own organic efforts. But we're very happy about how G Trophy is doing. It's set up as a separate company. So that's one. And the second is, out of our 918 odd open order book, you can think large majority is map-led, around approximately 3/4 to 80%. So less 20% is coming from IoT-led. And in IoT-led especially, there's you can't really estimate how many new subscriptions or new devices customers will buy. So that's why, adding a lot of customers there is super good, because, that is where the surge will also come in.
All right. Thank you so much for joining in and giving us all those details. You've broken up your order book for us the best way you could, and given us an outlook on the numbers going forward. 40% is something that we'll be looking at, both your margins as well as revenues. So that's MapmyIndia. With that, we shift focus to our special segment where we get you ideas for profit. Coming in from our colleagues at Money Control Pro, Nitin Sharma joins in.
CGD companies have been seeing margin collapse due to record high gas prices, and IGL is no exception. In the last 5 years, IGL's volume has grown at a CAGR of 10%. However, in the last 1 year, its margin declined from 20% to 11.5%. This consistent margin decline is going to stop now as LNG prices have come down and APM gas price policy have changed, which should lead to reduction in the gas cost for the company. In the 9-month FY23, IGL's gas volume reached all-time high of 8.1 MMSCMD, led by the CNG demand. Rising EV adoption is a key challenge for the company. In the Delhi, DTC and other stage carrier account for 20% of its volume, and this is going to change as the Delhi government has set an ambitious target of replacing aging CNG buses with electric buses, and the impact should be seen by FY24 onwards. IGL's management guidance include a 9 MMSCMD by FY24 and 10 MMSCMD by FY25 volume, a unit EBITDA of rupees 7 to 8 per SCM, and a capex of 1500 crore per year for the next 2 years. We are of the view that incremental volume growth would be met via non-APM gas that would keep margin in a tight spot for coming year. Hence, the cost structure for the company has changed. Overall, we forecast an 11% CAGR in the gas volume that should translate into revenue and EPS CAGR of 20% and 12% over FY22 to 25. The stock is trading at FY25 PE of 18 times, which appear attractive with a medium-term view.
Thanks, Nitin, for that. Time to slip in a short break. On the other side, we'll be joined by the Chairman and Managing Director of Raj Ratan Global Wire. Stay with us.
For March 2023, the credit card spends grew by 28.2% YOY and about 15.7% on a month-on-month basis to more than 1,35,000 crore. While monthly spends are the highest ever for the credit card sector, the credit card issuances also have remained healthy as always. So in March 2023, the credit card issuances grew by 2.3% month-on-month and about nearly 16% on a YOY basis. Card issuance growth is the best in last 9 months. Average spends was at about 16,143 rupees, which is up 10.6% YOY and about 13% on a month-on-month basis. So average spends are the second highest that you are seeing post Diwali. Let's look at the top 4 performance. So performance for March, now with Citi's number being in the Axis details, a card market share for the top 4 has risen to 71.37% when compared to 68% in the previous month. Spends
Welcome back. As promised, let's get chatting with the management of Rajratan Global Wires. The stock dipped on Friday by almost 6-7% post the numbers reported by the company, and today as well is lower. It was a weak fourth quarter with the revenue as well as margins were under pressure. The revenues fell by about 11% year on year. And we have with us Mr. Sunil Chodia, who is the chairman and managing director of the company, to discuss these results, more importantly, the outlook going forward. Thanks a lot, Mr. Chodia, for joining in. You had said that, on a full year basis for the full company, your volumes will be flat, and flattish they were, a mild negative tinge, though we saw further weakness in Thailand. Just wanted to understand your prognosis for the next year. You had earlier guided for 15 to 20% sort of volume growth. If you could tell us, how much would come from India, how much will come from Thailand, and is there a strategy shift that you're doing in Thailand? Would that come at the cost of margins?
Yes. So, yes, I agree with you. Last year, the business had degrowth in Thailand for reasons well known to all of us. It was geopolitical problem in Europe, which had a pressure on the overall requirement of tire companies. So we could not achieve the targeted volume. We were short of even previous year's volume. And we did do better in India. We grew by 5,000 tons, which was also not enough. But going forward, we have some learning from last year. And, we have aggressive plans. We have started an office in Europe to market our products. And we are targeting 40,000 tons volume from Thailand and 70,000 tons volume from India. This translates into 20% volume growth for current year for us.
All right. So 110,000, Mr. Chodia, is what we're going to be working with. We get that. That will be a good growth. So let's see whether or not you can achieve that. Now, on the margins front, things have been a little bit wobbly, so to call it. You're down to mid-teens odd. But you had told us earlier that you were looking at volumes, blended margins, I think of close to around 18 to 20%. What is the realistic number going by the current operating leverage that will play out, as well as, the other measures that you've taken? And a quick word, I derived your Thailand margins. For the past quarter, they had come down to sub 10%.
Yes.
Will things recover from year on for that division as well?
Yeah. So, Thailand last quarter was the worst. The overall EBITDA margin for the year was 15%, but last quarter was below 10%. And also the volumes were lowest. So because, the customer contracts are for quarter. If you lose the business, you lose the business for the entire quarter. So we have taken some corrective measures now for current quarter, and the visibility for the year is very positive. We couldn't supply the required quantity to our biggest customers Sumitomo last year, which has come back with big volumes. We have got some new approvals from Korean customers, so we'll be doing business with them. And overall, my projection for EBITDA margin in Thailand will be around 15%, and for India around 20% this year.
So blended will be how much? Around 18%?
Blended or consolidated 18%.
18%. All right. Just one more question, sir. On your Thailand market share, in the presentation, you're still talking about mid-20s. But I believe in the last quarter, there were imports, there were Chinese that were supplying, at lower cost. And that's where market share got hit. What was the market share for the last quarter in Thailand? In India, I think it's around 45%.
No. So last quarter, we were hit in the margin as well as in the market share. So last quarter, market share came down to 18%. And overall for the year, it was 24%. Which used to be 26% before last year.
Right. So just wanted to understand, going forward, will you get back to that 24%? Will you increase your market share? By when?
Definitely. We have had discussions with customers and we have taken corrective steps, whatever was required. And this year, the market share will be beyond 26%.
Just wanted to understand your thoughts on margins once again. You have guided for 15% margins in Thailand, but then this at a time when you are increasing capacity, this at a time when you are facing competitive challenges, this at a time where you're facing geopolitical risks as well. Are you confident of the volumes and the margins that you're guiding for in Thailand in such situations? Or do you think there is a bit of a downside risk?
No, there is no downside risk. This is very carefully calculated number. I'm talking based on the approvals, new approvals, and the business has started in this quarter. I'm based, and the geopolitical problem has also become like normal. Today, whatever it has affected, it has come to a standstill situation.
Yes.
So European purchases have gone up. We are able to export some quantities, and our customers are also able to export bigger quantities to Europe and America. So this should be possible.
All right. We're going to track this closely because last year to scale it down a little bit, but this year you seem to have taken everything into the price and then you're giving that guidance. So, Mr. Choudhary, the reason we are asking you these questions is because last year you did an EPS of around 20 rupees. The stock is still around 800 rupees. Even after such a sharp correction, it's trading at around 40 times. The hope is that things improve from here on. Before we wind down, tell me about the Chennai plant. When does that get commissioned? Out of the total quantum that you wanted to spend, how much have you already spent and how much is remaining to be spent?
Yeah, so Chennai, we are targeting to start mid of the year. We'll start trials by August and maybe commercial production by Q3 of this year. We have up till now spent 135 crores in Chennai, and we'll be able to start production with a total capex of 200 crores to begin with. And remaining 100 crores would be spent in next year. So that is about it.
All right. And what does that mean for your overall revenue this year and FY25? Because in FY25, we'll obviously have the full effect of the Chennai plant and your Thailand plant will also go into full utilization. FY24 and 25?
This year, the top line should be around 1100 crores. And FY25, it should be 1350.
All right. And that number you gave on the Chennai plant, you spent 155 crores. So 45 crores are remaining.
135 up till now, and remaining 65 will start the production. And we will spend the balance 100 crores in coming years.
Okay, all right. Okay, and very quickly, are you a buyer in the stock right now? Because it's corrected so much from the top.
I'm always buyer. Whatever little savings we have, we keep investing in Basel.
Yeah, because as I mentioned, the valuations seem to not be in favor, but you have shown the faith in the past. So I thought I'll quiz you on that. And you've said that, with the
because we are long-term investors, so I don't look at the current price while investing.
And probably you'll be the best analyst of your own stock, Mr. Choudhary. Thanks so much for stopping by. We'll hold you at these numbers, mild you, but you seem to have done a detailed analysis with your team and you've given us some guidance. Thanks so much for joining in. For the time being, though, we'll slip in a short break. On the other side, we'll continue our focus on the markets.
For March 2023, the credit card spends grew by 28.2% YOY and about 15.7% on a month-on-month basis to more than 1,35,000 crore. While monthly spends are the highest ever for the credit card sector, the credit card issuances also have remained healthy as always. So in March 2023, the credit card issuances grew by 2.3% month-on-month and about nearly 16% on a YOY basis. Card issuance growth is the best in last 9 months. Average spends was at about 16,143 rupees, which is up 10.6% YOY and about 13% on a month-on-month basis. So average spends are the second highest that you are seeing post Diwali. Let's look at the top 4 performance. So performance for March, now with cities number being in the Axis details, a card market share for the top 4 has risen to 71.37% when compared to 68% in the previous month. Spends market share is at 74.74% for the month of March versus 71.9% on a month-on-month basis. Remember that Axis Bank's numbers now have cities numbers as well in March. So spends market share in spends is at 12% for Axis Bank versus 9% month-on-month, a gain of nearly about 300 basis points, while credit card issuances market share for Axis Bank now is at 14.2% versus 11.5% on a month-on-month basis, a gain of more than 270 basis points month-on-month. So in the top 4, due to Citi acquisition, Axis Bank has gained market share in spends by about 321 basis points. Ex-Citi Axis Bank would have gained market share by 24 basis points. HDFC Bank has gained market share by almost 82 basis points to 27.
Welcome back. It's looking like a quiet market, but a couple of stocks are taking off. IDFC First Bank, the intraday chart should come up for you on that one. That's moved to the high point of the day. HAL or Hindustan Aeronautics, well, that stock as well is up close to around 2%. Bulk of that coming in the last few minutes. And RVNL as well, that one as well. Just take a look at it. Flying away. Very, very large volumes being seen on that one. So though the headline indices are more or less flattish, there are plenty of stocks that are doing well.
Yes, Nigel, they're doing well. And the RVNL thing itself is the entire rail pack, which is surging right now as we speak. Ircon is up 10%. Railtel is higher as well by about 4% odd. All these stocks have moved to the high point of trade. So yes, the mid-cap index is a buzz, while the frontline index is absolutely flat. We'll wrap up on this edition of Chartbusters. You stay tuned. Trading Hour comes up next.
सदियों से चुप बैठी आज मुंह खोलूंगी तोड़ के दरवाजे सारे आज सच मैं बोलूंगी सहनशीलता को मेरी कमजोरी ना समझो तुम.
It's rare to see a 12-year-old speak about gender stereotypes, but for Swati, it's normal. She and her classmates have been part of Slam Out Loud's Jijivisha program for the last 8 months. And for them, such performances are a learning experience that teaches life skills and awareness around cultural and social issues. Swati is among around 12,000 children from disadvantaged communities across 5 Indian states who are learning creative confidence skills under Slam Out Loud's unique program that uses performance and visual arts to build socio-emotional learning skills.
For children who come from low-income backgrounds, all we do is restrict what we do with them to either academics or at best getting a job. And I thought somebody should be doing something about these children.
But what led to this idea?
One day I actually landed up in Kashmir, and when I walked into that class, I was doing this workshop. I asked children to pick an emotion and write a small poem on that emotion. And most children, like about 30 out of 35 children in that classroom, ended up writing about emotions of anger, confusion, sadness, hate, feelings of isolation. And I think on that particular day, I did not have a response to that as a teacher.
For Labru, the response is still not complete, but it's gaining form.
We are here at the Vikas Valley Public School in Delhi's Uttam Nagar area, where Slam Out Loud has been conducting the Jijivisha Fellowship for a year. The fellowship places artists into the classroom of low-income schools. Slam Out Loud in-person programs serve around 12,000 disadvantaged children across India and 5 million children globally through their online programs.
The going has not been easy because for so many schools catering to children from low-income households, attempts to go beyond academics in the classroom has been met with resistance.
जिस माहौल के अंदर हम यहाँ स्कूल चला रहे हैं, यहाँ पेरेंट्स सिर्फ अपनी फ़ीस दे दें वही बहुत है। क्योंकि जब मैं ये चाहता था कि हम कुछ ऐसी कोई भी एक्टिविटी करें, बट जब हमारे पास यहाँ पेरेंट्स का फीडबैक आया कि सर हमें एजुकेशन के अलावा कुछ मत दीजिए आप, क्योंकि हम इससे ज़्यादा पेमेंट नहीं दे सकते हैं आपको।
But Slam Out Loud did not give up. A few schools recognized the benefits of this program and were accommodating. Early success stories led to investors and donors, and more schools adopting the program.
The performances that we've seen the children give and the interactions that we've had with the children demonstrate the value of having access to creative arts.
The success of these programs is visible in the kind of response it has evoked in students.
मेरे प्रिय शरीर, तुम कैसे हो? मैं तो ठीक हूँ, और तुम?
11-year-old Ansh says the program has helped him discover a talent for storytelling and a love for poetry.
So in 2019 I had this child and she was very shy, not sharing many things. I was in touch on WhatsApp. I started a Sunday's Kahani Day with them. Then recently we got an opportunity to perform in Kala Ghoda in Mumbai. So I called that child because she sent me one story that she has written. So I said, come, let's perform. And we practiced with her, and then the first from the batch, she went to Mumbai. No one in her family went outside Delhi.
Children who have been part of this program have to date created 1 lakh original artworks, conducted more than 70 workshops, performed
Good morning. Welcome to Trading Hour. It's a brand new week. I'm Reema Tendulkar. With me are Surbhi Upadhyay and Pavitra Parekh. Girls, who thought like today was the day we were going to break out? In the morning, tell me, did you think that markets would be doing a lot better than a 12-point
You know,
up move?
I don't want to say this, but I had a feeling.
That you would do better? We would do better?
No,
or?
the fact that this is going to be a bit of a no reaction, because in Reliance, absolutely fantastic numbers. What's new? What's new that can materially move a stock as large as RIL? Yeah. And for ICICI Bank, this is what we're discussing even ahead of time, right? That margins are peaking is the best in the price, and then the market's mood, I think, is just... it's a, you know, what should I say?
No
Nonchalance, no show.
No show. We're wedged in such a tight band. Okay, did you think we would do better than what we're doing right now?
Definitely better than 12 points, right? We were all talking about that. And maybe
even the SGX Nifty was more excited.
The SGX was more excited. We were talking about how all of last week was so dull, and you know, Wipro is moving well, IT is holding up. What more do you do to make the market move?
Well, today, unfortunately, Asia is a bit on the back foot. So Kospi is down close to about 1%. Hang Seng is down about 0.6%. But you know, if you pull up the contribution plate, you would see that there is no one big drag on the markets. On the way up, yes, you've got a positive momentum coming in from ICICI and Reliance post the numbers. But on the way down, unlike last week, which is all about IT and that, you know, big drag coming in from IT, look at the contribution plate. You've got minor downticks in many stocks across sectors. Kotak Mahindra Bank and L&T, ITC, Sun Pharma, across, across individual sectors, you've got some stocks. But all in all, markets continue to remain wedged in a very, very tight band. Right now, markets opened up well. They had a slip. And the current levels on the Nifty and the Sensex are just a fractional of a gain. Up 10 points on the Nifty, Sensex up 40 points. That said, we've got a lot of cues lined up through the course of this week. It's going to be an action-packed, busy week today. Numbers from IndusInd Bank and Century Textiles. But later this week, you've got Axis Bank, Kotak Mahindra Bank, Bajaj Finance, FinServ, HDFC, Asset Management in the FMCG pack, Tata Consumer, Nestle, HUL. IT names like Tech Mahindra, Wipro, Ultratech Cement, Maruti Suzuki. I'm listing out all the companies that are going to be declaring numbers in this week itself. So it's going to be an action-packed week. Plus, you've got the primary market hot, Mankind Pharma IPO. It's a large company hitting, you know, for subscription from tomorrow onwards. And plus, you've got the expiry as well. Mid-caps were holding up pretty okay, up, you know, at least for the last couple of days. But today, the performance is absolutely flat. But in the month of April, mid-caps have outperformed the benchmark indices.
Okay, well, that's the local picture. If it, you know, makes us feel any better, I think globally as well, there's no real trigger that is leading to a big directional move. It's kind of one day up, one day down, right? Asia, as Reema pointed out, markets are down. The Hong Kong market, by the way, is down about 1%. Some of the regional markets like Singapore are closed for holidays. But largely speaking, it's tracking cues, tracking earnings, even in the global landscape. I was looking at some of the numbers that FactSet puts out in terms of earnings season in the US. Now, the companies that have reported on the S&P 500, 78% are above estimates, so 76% rather. But the market isn't too enthused. Why is that? Because anyway, estimates are saying that there will be an overall 5.2, 5.3% sort of a decline in S&P 500 earnings. So while, yes, you're beating estimates, there's no taking away from the fact that corporate profitability has fallen as the calendar year kicks off. And maybe that's kind of weighing on sentiment. There's a lot lined up, by the way, a lot of tech earnings this week. You've got Meta, Amazon, Alphabet, Microsoft. Today, in terms of global earnings, is this Coca-Cola. Some of these troubled banks, Credit Suisse, for what it's worth, will report. First Republic Bank will report today. So there's a lot lined up in terms of the earnings calendar. But the market's been extremely range-bound. There's macro data as well. There is Q1 GDP, there's consumer sentiment, and of course the guessing game continues into whether it's a 25 basis points rate hike from the Fed in May or not. That is the consensus right now. Look at the bond markets. I mean, you're not getting any cues there. That US 10-year has been so range-bound around the 3.5% kind of pivot. Dollar between 101 to 102, locked in a range. Crude also, I mean, it does give you these wild moves in terms of price action, 3-4% one day up or down, but largely crude hasn't done too much. It's still hovering in about a $5 kind of a band around the 80 mark. So guys, well, it's not just our markets, it's asset classes around the world, it's equities pretty much around the world that just don't know where to. You know, there used to be a saying, sell in May and go away. I don't know about the tribe. That's what people are already, they're preponing that to April.
You know, you said if it makes you feel better, it makes us feel a lot better, you know, that this is happening everywhere else as well. We don't have to sit and watch the screen like this just by ourselves. But, you know, since we were talking about the markets being dull, the small cap index is holding up well today. So that's up more than 0.5% right now. The advanced decline also positive, just mildly positive, but it is positive right now. I'm going to just point out a few of the spaces where we are seeing good moves come through because we've gone through enough of the flat action. You have some of the tech names which are doing well. Take a look at Cyient, it's up 3% right now. You have something like a Persistent, LTI, Mindtree, which are holding up better. Some of the banks, the smaller banks that is, so take a look at Punjab and Sindh Bank, your Bank of Maharashtra, these ones seeing good gains. And take a look at all of the railway linked stocks once again after the kind of move that we saw earlier in this month. These are the kind of gains that you're seeing. RVNL is up almost 10%, you have RailTel seeing a 5% move, Ircon as well up almost 10%. So that's what's going on with the stocks. We will keep coming back to this, but first up, let's bring you our top story today. The Reserve Bank has offered HDFC Bank relief on priority sector lending norms and has permitted the merged HDFC entity to now hike stake in HDFC Ergo as well as in HDFC Life to over 50%. This is before the effective date of the merger. So what does this actually mean and what are the brokerages saying on this? We have Abhishek here with a complete roundup. Abhishek.
Well, Pavitra, as you mentioned, you know, RBI has provided certain clarification for requests made by HDFC Bank and HDFC Limited with respect to merger of both the entities. So first up, for priority sector lending target, 1/3 of HDFC's outstanding loans will be taken care of priority sector lending target for first year. The balance 2/3 will be done over the next 2 years. So this is a big relief in terms of meeting the priority sector lending norms. Investments including arms and associates of HDFC Limited can continue as investments for HDFC Bank. So with respect to stake in HDFC Life and HDFC Ergo, the bank can take up stake over 50% in both the entities. For HDFC Credila, they have to take the stake to 10%, down to 10% within 2 years. Other highlights are that they have to comply with CRR, that is cash reserve ratio requirement, SLR statutory liquidity ratio requirement, and LCR, that is liquidity coverage ratio without any exception. So from day one, they will have to meet the CRR, SLR and the LCR requirement of the merged entity. So HDFC's rates to be linked to benchmark within 6 months. This is a positive news given the fact that this will help in the yields remaining on the healthier side. HDFC Bank has arranged a con call in which they say the requirement for PSL kicks in only 12 months after effective date. So they have some time in terms of, meeting the requisites, carrying excess LCR already in the balance sheet, and they are also carrying excess SLR as well as the CRR above the requisite norms. So brokerages have written note. CLSA says that a glide path of 2 to 3 years provides adequate time for HDFC Bank to reduce its priority sector lending norms versus negative PSL impact that would have happened on day one of the merger. Bernstein has also written, they say that the development increases the confidence of a smooth merger process for HDFC Bank and HDFC Limited. The pros and cons of RBI announcement: priority sector lending requisite meeting time is sufficient for the lenders to meet that norm. However, meeting CRR SLR requirement from day one can have slight impact on the immediate earning profile of the merged entity. However, it will get played out over the next couple of quarters. So things which are still pending with RBI in terms of the application and permission sought by SDFC Bank and SDFC Limited is clarity on valuation of certain assets that are held by SDFC Limited. Now, project financing loans that SDFC Limited has provided, there is more clarification needed with respect to certain procedural matters over there, and small investments in the book of SDFC Limited, how that will get accounted in the bank. So these are some of the key clarifications that SDFC Group is awaiting. Back to you.
Okay, thank you very much for that. So relaxation on the priority sector lending, but no relaxation on CRR or SLR requirements. But the stock of the day in the group is HDFC Life. It's now up close to about 4% in trade, but early in the morning it was up nearly 7%. Surbhi is here standing by with the news on what's fueling the up move in HDFC Life. Surbhi.
Thanks for that. So RBI's decision to allow the merged entity HDFC and HDFC Bank to own over 50% stake in HDFC Life comes as a double booster. Now with this, HDFC Life will become a direct subsidiary of HDFC Bank. Now currently it has around 50% stake in the HDFC Bank channel, which is likely to improve from here on. Also, this will help to reduce their cost of distribution in the HDFC Bank channel, which will in turn help them increase their margins. Also, the possible overhang of a 19% stake sale by HDFC and HDFC Bank, if the RBI had directed to keep the stake below 30%, is now gone. Rather, it is now certain that the merged entity will acquire additional stake before the merger completion. Currently, Aberdeen holds 1.6% stake in the company and Exide Industries holds around 4% stake in the company. Just to alert, in September of 2022, Aberdeen had sold nearly 2% stake in the company. On the back of this news, brokerages have also upgraded HDFC Life. MK has upgraded the stock from an hold to a buy rating with a target price of 650, and Investec says that the stake sale overhang is now gone and HDFC Life remains a preferred pick for them among the life insurance players. They have a buy rating with a target price of 560.
Okay, got that. Surbhi, so that explains a little bit of excitement around HDFC Live today. But tell us, I believe there is a Morgan Stanley note and they are sort of drawing out some takeaways for an ICICI group company, ICICI Lombard. What exactly is MS saying?
That's right. So Morgan Stanley has an interesting view on this. Now, initially, ICICI Bank had to bring down the stake in ICICI Lombard to 30% by September 2024. As of March 2023, they hold around 48% in the company. Now, Morgan Stanley says by allowing HDFC and HDFC Bank to increase their stake in HDFC Life over 50%, RBI has now set a precedent. On its Q4 earnings call, ICICI Bank did not specify if they would want to increase or decrease their stake in ICICI Lombard. But Morgan Stanley writes some implications for ICICI Lombard stock. Now, what are they? One, there is a possibility for ICICI Bank to increase their stake above 50%. Before, they had expected this to move below 30%. Now, increasing the stake would remove a big overhang from the ICICI Lombard stock, and they expect this to be in talking point in the market until ICICI Bank states which course will it take in the future.
All right, Surbhi, thanks a lot for getting us all of the details. So that is a complete roundup of what's going on with HDFC, HDFC Life, as well as ICICI Life. So that is everything that we're tracking right now. But with that, we do have to get into a short break. When we come back, we're going to focus on the commodity space. We'll bring you an update with Manisha Gupta.
Walk along the streets of Kiev, of Kherson, of Kharkiv, and not a lot of people have a lot to say. Well, in Kherson, there's nobody around to say anything. In many parts of Kharkiv, there's nobody around to say anything on the streets. But war is on everyone's mind. How do you read that? Read it on the walls, on the paintings, the figures, the graffiti, the posters. Some people have said it there, others are seeing it there. Let's hear of what Ukraine is saying without actually, of course, saying it. By the Krishatik street in Kiev, a row of posters remind passers-by of their Ukrainian past as distinguished, always now, from a Soviet and particularly Russian past. Along the Freedom Square in Kharkiv, the word is out. Keep calm and win. We will rule the cosmos. What is a marvel? It is the armed forces of Ukraine. Kharkiv is the hero city. Its people stand together. Everywhere, the walls speak their tribute to the fallen. A flag for every fallen soldier, but that was at the start.
Welcome back. You're still tuned into Trading Hour. A lot of the pharma companies are under pressure today. I mean, we did see a little bit of a run-up last week, but right now you have Sun Pharma, which is the biggest loser right now on the Nifty. So it's seeing a 2% cut there. Cipla, DRL are some more which are coming under pressure. Divi is also under pressure right now. But you know what's holding up? You have some of the two-wheeler makers which are doing very well today. So take a look at Hero Motorcorp. You have TVS Motors, which is doing well. Bajaj Auto also hit, Bajaj Auto did hit a 52-week high earlier this week as well. So that's what's happening as far as the two-wheelers go. But let's also talk about the commodity space now. We have Manisha joining us, and today she's going to tell us about the move that we've seen in crude prices. Hi, Manisha.
Thank you for that, Pavitra. And yes, with the kind of decline that we are working with, we're trading at a 5-week close for the crude oil prices. Last week was a 5% decline. And prior to that, in 4 weeks, the crude oil prices gained between 18 to 24% for the crude varieties there. Well, the decline comes in on the fact that we have seen strong PMI data come in from various economies. And that tells you that the interest rate hike could just about continue. And then the US also has added the oil and gas rigs for the first time in 4 weeks. Markets also are looking at or watching out for the first quarter GDP numbers that come in from US there. And then Russian exports also have continued to increase. Even with the output cuts that Russia has been talking about, the production and the exports are the highest since pre-COVID levels. And when you look at the numbers as well, these are on the higher side. And a statement from Russia does tell you that the revenue from the oil and gas exports in the year 2022 have been up by nearly 28%. So no dent really coming in from there. The US demand also has continued to decline, and we have seen that in the build-up that we've seen in US crude inventories, gasoline, distillate. All of those stocks have been rising, which is putting pressure on prices as of now.
Okay, got that. Thanks, Manisha, very much for giving us an update on oil. So a little downbeat on that side of the market today. We will take a quick break on that note. On the other side, we talk technicals, market's not moving anywhere. So can you look at individual stocks? What are the strategies like? Rahul Mohinder is going to be joining in.
For March 2023, the credit card spends grew by 28.2% YOY and about 15.7% on a month-on-month basis to more than 1,35,000 crore. While monthly spends are the highest ever for the credit card sector, the credit card issuances also have remained healthy as always. So in March 2023, the credit card issuances grew by 2.3% month-on-month and about nearly 16% on a YOY basis. Card issuance growth is the best in last 9 months. Average spends was at about 16,143 rupees, which is up 10.6% YOY and about 13% on a month-on-month basis. So average spends are the second highest that you are seeing post Diwali. Let's look at the top 4 performance. So performance for March, now with Citi's number being in the Axis details, a card market share for the top 4 has risen to 71.37% when compared to 68% in the previous month. Spends market share share is at 74.74% for the month of March versus 71.9% on a month-on-month basis. Remember that Axis Bank's numbers now have Citi's numbers as well in March. So spends market share in spends is at 12% for Axis Bank versus 9% month-on-month, a gain of nearly about 300 basis points, while credit card issuances market share for Axis Bank now is at 14.2% versus 11.5% on a month-on-month basis, a gain of more than 270 basis points month-on-month. So in the top four, due to Citi acquisition, Axis Bank has gained market share in spends by about 321 basis points. Ex-Citi, Axis Bank would have gained market share by 24 basis points. HDFC Bank has gained market share by almost 82 basis points to 27.4%. The top loser is ICICI Bank by about 189 basis points. Now the market share is 17.4%, and for SBI the loss is about 111 basis points, with market share being now at 17.9% on a YY basis. So credit card issuances, SBI card has gained market share by 202 basis points YY to about 19.65%.
Welcome back. You're with us on Trading Hour, and the market continues to be absolutely locked in that tight range. Rahul Mohinder is with us on this leg of the show. Rahul, I'm wondering what you're trading. Is anybody trading the index at all these days? You tell us, how do you look at things as the week kicks off, and what are the ideas?
You're absolutely right. It's a bit of a tug of war, and I think there's a lot of frustration building up within index traders that, we haven't moved for a couple of days, and I think it's just a test of time. We've seen this many times in the past, where the market struggles for a couple of days and then suddenly it comes, the breakout. But let's try and read the trend. I think first and foremost, we didn't break 17,550 over the last week, which I am clearly reading as a positive. That's a level I think a lot of people have in mind, clearly because of the kind of support the Nifty spot has demonstrated at those levels. Even from the Nifty bank perspective, I think we're still in a strong bull grip when we look at most of the indicators. And if I had to compare indices, yes, the Nifty bank is tilted slightly more positive than the Nifty. So keeping the overall trend as a positive in mind, I think one has to be stock selective in such a market. And, let me share some ideas. On the pressure side, on the sell side, I think something like an ITC, which hit that 410 level today, that could be, a stock which does demonstrate some weakness, in my opinion. 405 to 410, in my opinion, is a strong window of resistance for ITC. We probably could push back to about 395, 396 levels. So that could be on the sell side of things. But to balance it out, you've got some outperformers, which I can see in a stock like Titan, where I clearly see the stock will move to about 2670 levels. One could buy even at the current market at 20, with keeping a 2560 stop loss. Another stock which has corrected quite rapidly in the near term is Maruti. And, it's come to that 8450 to 8500 belt, which I'm identifying as good support. One could use this as an opportunity to get into Maruti, keeping a clear stop loss below the 8450 mark. I think, again, a trot back up to about 8630, 8650 is fairly likely. Now, another stock, if I could add within the auto space, is Tata Motors. Here, too, we've seen a very resilient performance over the last couple of weeks, despite a tepid index. But, Tata Motors has stood out, and I still think is good for more. Probably, if you're short-term, 482 could be a near-term target. I'd buy with a 463 stop loss.
Okay. Thank you very much, Rahul, for joining in. Let's talk about some other movers, and this time on the way down, it's Sun Pharma. That's the top Nifty loser. The company has received a letter from the US FDA for its Mohali facility. The company is now, Ekta is now joining in with the details. Ekta?
Thanks for that. Well, yes, definitely negative news which is coming for Sun Pharma, because they have received a letter from the US drug regulator for their Mohali facility, which is located in Punjab. Now, the letter is titled basically a consent decree correspondence. A consent decree was basically provisions to apply to or adhere to compliance which they had entered in 2013 when they were a part of Ranbaxy, and this basically is a non-compliance letter and a part of the consent decree which they had received or were a part of a couple of years ago. Now, the US FDA, for this particular communication which has taken place, is probably linked to the fact that they had inspected the Mohali plant in August of last year. At that point in time, they were issued 6 observations, and at that point, the street had brought up concerns that maybe there could be a linkage to data integrity in these observations. Hence, the street was expecting an escalation. Now, in terms of the current developments, the company is going to be taking certain corrective actions before releasing final product batches into the US. Actions include retaining an independent expert to conduct batch certifications. The company has said that this is basically a temporary pause in terms of release of batches from the Mohali facility. The likes of Incred have said they expect a low mid-single digit impact on numbers from a 3 to 6 month time perspective. Now, the larger impact of this particular development is also that the second plant of Sun Pharma is now under the US FDA scanner just in the span of a couple of months. In December of last year, they had their Halol facility, which is one of their largest facilities supplying to the US, which was issued an import alert. Before that, previously, the Halol plant was issued a warning letter in 2015, which was eventually resolved in 2018. So this is making the street question the company-wide regulatory compliance because of the developments which have taken place on Halol as well as Mohali just in the span of a couple of months. However, the markets are bullish on the company's specialty business and the fact that they would be launching key drugs in the US. Hence, that is possibly going to cushion some of the fall. Nomura has a buy target price of $11.90. According to them, the development is a negative surprise. It is US FDA's step to ensure further scrutiny of batches, signals an escalation of the matter. JP Morgan has an overweight rating and a target price of 1200. They see limited financial impact on account of these developments, given it's a temporary pause.
All right, Ekta, thanks a lot for getting us all of the details on Sun Pharma. It is the top loser on the Nifty this morning, and it is around 2% in the red. But one stock which is holding up well is Ami Organics. This after it announced its semiconductor foray, so it has acquired majority stake in specialty chemicals maker Baba Fine Chemicals. So Sonal is here to tell us more about that. Sonal.
Thank you so much for that. Well, it's an interesting foray that the company has actually entered into. They will be catering to the semiconductor industry. It is via an acquisition of a company that provides chemicals to the semiconductor industry. That's the kind of exposure they'll have now. They've acquired 55% stake in Baba Fine Chemicals, which is a custom specialty chemicals manufacturer for semiconductor industry. Here, the consideration for this stake is 68 crore rupees, subject to adjustments that may be required at the closing stage of this particular transaction. The combination of this consideration is cash and also issuance of securities of the company to existing parties. This is on a preferential basis. Valuation, according to the company, is 4 times adjusted EBITDA for FY23 of the company which is being acquired, and deal is expected to be completed in 6 months. If we just go through the revenues as well, for Baba Fine Chemicals, they have been increasing from levels of 26 crore rupees in FY21. Company has been able to do revenues of 47 crore rupees in FY23. That's basically doubling in last 3 years. And it is, of course, a positive update because this industry is it has high entry barriers. So this acquisition gives them that entry into an industry which is little difficult to tap, and they will get a good partner here as well, which already has the technology and know-how to make chemicals for the semiconductor industry. Analysts say this acquisition will be EPS accretive and will help in ramping up volumes for the company. So all in all, it's a good takeaway for the company.
Thank you very much for that. We'll slip into a break. On the other side, we'll focus on the earnings reported by ICICI Bank and Yes Bank and the earnings expected from IndusInd Bank. Stay tuned.
For March 2023, the credit card spends grew by 28.2% YOY and about 15.7% on a month-on-month basis to more than 1,35,000 crore. While monthly spends are the highest ever for the credit card sector, the credit card issuances also have remained healthy as always. So in March 2023, the credit card issuances grew by 2.3% month-on-month and about nearly 16% on a YOY basis. Card issuance growth is the best in last 9 months. Average spends was at about 16,143 rupees, which is up 10.6% YOY and about 13% on a month-on-month basis. So average spends are the second highest that you are seeing post Diwali. Let's look at the top 4 performance. So performance for March, now with Citi's number being in the Axis details, a card market share for the top 4 has risen to 71.37% when compared to 68% in the previous month. Spends market share is at 74.74% for the month of March versus 71.9% on a month-on-month basis. Remember that Axis Bank's numbers now have Citi's numbers as well in March. So spends market share in spends is at 12% for Axis Bank versus 9% month-on-month, a gain of nearly about 300 basis points, while credit card issuances market share for Axis Bank now is at 14.2% versus 11.5% on a month-on-month basis, a gain of more than 270 basis points month-on-month. So in the top 4, due to Citi acquisition, Axis Bank has gained market share in spends by about 321 basis points. Ex-Citi, Axis Bank would have gained market share by 24 basis points. HDFC Bank has gained market share by almost 82 basis points to 27.4%. The top loser is ICICI Bank by about 189 basis points.
Welcome back. Well, one stock that continues to be in focus is ICICI Bank. In this dull market, it is managing to hold up around 1.5%. And what a blowout quarter it has been for the bank. You're talking a 40% growth in net interest income, 30% growth in profits, and margins almost touching 5%. Let's get to Abhishek Kothari to understand what's powered this kind of a move. Abhishek, dream quarter for ICICI Bank, right?
Well, it's been a robust quarter for ICICI Bank, and Sandeep Bakshi has created a history for ICICI Bank in terms of its Q4 FY23 performance. So if you take a look, the net interest margin is at all-time high. Domestic net interest margin has crossed the 5% level, and international net interest margin is at 26-quarter high. You take a look at the NII growth of more than 40% on a YOY basis is perhaps the best that you are seeing in last 8 to 9 quarters, or even 8 to 9 years, sorry, or even 10 years. Highest ever quality return ratios. You are seeing ROA of 2.39% and ROE of about 18.9%. Asset quality, one of the best in last 8 years or even more. Gross NPA ratio has come down to 2.81% and net NPA ratio is down to about 0.48%. You are seeing this net interest margin movement being largely aided by the fact that unsecured portion of the loans are at 22-quarter high in terms of the percentage of loans. So that is now at 19.4%. On the flip side, the deposit growth on a YY basis is below 11%. Now that needs to catch up with the loan growth going ahead. So going ahead, as management has indicated, there could be pressure on the net interest margin from the current levels. PNL, NI and PAT is a beat on our poll. What brokerages are saying that ROE will increase to about 17 to 19% over the next couple of years. They have raised estimates anywhere between 3% to 9%, and they see uptick in deposit mobilization as a plus, and they expect that to continue in FY24 as loan growth actually accelerates. So across brokerages, you are seeing positive recommendation with a target price ranging from as low as 1100 per share to as high as 1200 per share. Back to you.
Indeed, thank you very much for that. ICICI Bank's stock price is below 900, almost at 900, 896. But look at the target price. Morgan Stanley pegs the target price at 1250. CLSA is at 1200. Jefferies is at 1180. So brokerages very, very bullish on the prospects for ICICI Bank. But let's also listen in to what... Okay, we'll get to that in just a moment. We'll find out.
We'll look at, Rima, let's actually, before we move ahead, let's look at Sandeep Bakshi's bites, because he gave some commentary on the business trajectory going ahead.
Including non-fund based outstanding, the retail portfolio was 45.7% of the total portfolio. The business banking portfolio grew by 34.9% year-on-year and 7.8% sequentially. The SME portfolio grew by 19.2% year-on-year and 6.2% sequentially. The growth in SME and business banking portfolios was driven by leveraging our branch network and digital offerings such as InstaBiz and Merchant Stack. The domestic loan portfolio grew by 20.5% year-on-year and 5% sequentially. The overall loan portfolio grew by 18.7% year-on-year and 4.7% sequentially. Looking ahead, we see many opportunities to drive growth in the risk-calibrated core operating profits. We believe our focus on customer 360, extensive franchise and synergy and collaboration within the organization, backed by our digital offerings and process improvement and service delivery initiatives, will enable us to deliver customized solutions to customers in a seamless manner and grow market share across key segments. We will continue to make investments in technology, people, distribution, and building our brand.
That's ICICI Bank for you. Let's talk about Yes Bank. The stock is down 3.5% in trade. Prima facie, it looks like a mixed set of numbers. On one hand, the gross NPA or the asset quality has deteriorated, but on the flip side, the company's net interest margin is the best in the last 9 quarters. But as I said, the stock is weak in trade. Earlier today, we had a chat with Prashant Kumar, the MD and CEO of Yes Bank, on the quarter gone by and the outlook going ahead. Listen in.
In the FY24, the slippages would be somewhere between 1 to 1.5%. Retail is growing much faster than the corporate. So even the last year growth has been 38%. I think this trajectory would continue for some time, and retail would be somewhere around 50% of our balance sheet. Regarding the NIMs, I think we are still in that trajectory where for us this is not peaking out. This would be a continuous upward journey for us.
Right, that is the word from the Yes Bank management, but the focus will continue to be on banks this week. We have many large ones, IndusInd Bank today, we also have Kotak and Axis later in the week. But Abhishek is back with us to tell us how IndusInd's numbers could really look this time around. Abhishek, what's expected?
So IndusInd Bank is expected to have a strong quarter this time around with highest ever quarterly PAT. They have already given the business update in which the deposit momentum is pretty strong at 14.6% YOY and about 3.4% quarter on quarter. The loan growth coming in at 21.3% YOY is perhaps the best in last 15 quarters, and sequential loan growth of 6.6% is perhaps the best in last 16 quarters. However, on the flip side, their CASA ratio is at 9-quarter low, coming in at 40.1%, and calculation shows that CASA has declined in absolute value by 1.3%. So retail deposit, that momentum continues to remain healthy at 15.2% YOY and about 3.7% quarter on quarter. And CD ratio is at 9-quarter high in terms of coming in at 86.2% when compared to 83.6% in the previous quarter. So you can expect the net interest margin to improve YOY as well as quarter on quarter. Phillip Capital estimates 10-quarter low slippage of about 1,400 crores. So asset quality is expected to improve on a sequential basis. Previous quarter, the gross NPA ratio was at 2.06%. Commentary in terms of business growth going ahead will be an important factor to watch out. So our poll suggests NII growth of 18.3% YOY and about 5% sequentially, while PAT is expected to grow at 47.8% YOY and about 2.5% quarter on quarter. Back to you.
Thank you, Abhishek, for that. Let's move on now from banks to chemicals. This is our quarter se quarter tak segment where Sonal brings us up to speed with the expectations from the chemical space. Sonal.
Thank you so much for that. Well, every chemical company has a different fundamental and factors affecting individual performance as well. But if I talk about the overall chemical industry, it is largely expected to have an improvement on a quarter-on-quarter basis. This is due to pickup that we'll see in exports. But there could be a muted performance YOY in some cases due to a weak global demand environment. Now let's talk about raw material costs. Basic chemicals, they have seen a decline in pricing, and that is because crude prices fell 8% on a sequential basis. Feedstock for oleochemicals, that was down 20% on a sequential basis, and ocean freight rates, they are down anywhere between 40 to 50%. So this will of course aid margins quarter on quarter. But demand pressure will continue in discretionary sectors like dyes and pigments, polymers, something companies that they have been telling us. Now the fluorochemical space particularly. Sustained high price in refrigerant gases will aid earnings. However, there will be weakness in packaging and technical textiles business. This is just for SRF, and that's why revenue will be flat. EBITDA and profits for the company will be down this time. However, for Navin Fluorine, earnings will be aided by high-performance products and specialty chemicals segment, leading to a 56% revenue, 98% EBITDA, and 52% growth in profit after tax. For Aarti Industries, which recently saw demerger of the pharma business, we will not be able to compare numbers YOY due to the demerger. but incremental revenue will come in only from new capex after FY24. And that's why revenue is flat in Q4, EBITDA is up, but the profits are expected to be down by 2%. For oleochemicals player Galaxy Surfactants, it will be a steady performance after some weakness that we saw in last couple of quarters. Volumes are expected to grow 6%. Performance surfactants will be up 10%, but specialty, which is the higher margin business, will see flat performance. For Jubilant and Grevia, operational metrics will be weak, down anywhere between 11 to 15%. This is, of course, in a high base. Acetic acid, which is the raw material, has seen a 40% decline in pricing, which will lead to lower revenues for the company as well. Generally, active ingredients have seen a decline, and that's why performance will be weak. Now, taking you through the stock moves this year and valuations, barring few, these stocks have underperformed. SRF, Naveen Fluorine, they are up anywhere between 8 to 16%. However, valuations for Naveen Fluorine are at an industry high at 45 times. Galaxy Surfactants is up with valuations at 23 times. Aarti Industries is also on the lower side. It's around down 10%, but valuations at 33 times. As far as the new listings are concerned, Tattvachintan, Clean Science, Chemplast, all of them are down anywhere between 7 to 23%, with valuations very low for Chemplast at 13.5 times, and for Clean Science 40 times after listing at around 80 times. So big fall is what we've seen there.
Okay, thank you very much. Very interesting there, Sonal. So many small companies, different companies, but the dynamics are different for each of them. Thank you for taking us through that. Get into a break. On the other side, we'll discuss markets, the way forward. Ashutosh Bhargav from Nippon India Mutual Fund joins in next.
सदियों से चुप बैठी आज मुंह खोलूंगी तोड़ के दरवाजे सारे आज सच मैं बोलूंगी सहनशीलता को मेरी कमजोरी ना समझो तुम.
It's rare to see a 12-year-old speak about gender stereotypes, but for Swati, it's normal. She and her classmates have been part of Slam Out Loud's Jijivisha program for the last 8 months. And for them, such performances are a learning experience that teaches life skills and awareness around cultural and social issues. Swati is among around 12,000 children from disadvantaged communities across 5 Indian states who are learning creative confidence skills under Slam Out Loud's unique program that uses performance and visual arts to build socio-emotional learning skills.
For children who come from low-income backgrounds, all we do is restrict what we do with them to either academics or at best getting a job. And I thought somebody should be doing something about these children.
But what led to this idea?
One day I actually landed up in Kashmir, and when I walked into that class, I was doing this workshop. I asked children to pick an emotion and write a small poem on that emotion. And most children, like about 30 out of 35 children in that classroom, ended up writing about emotions of anger, confusion, sadness, hate, feelings of isolation. And I think on that particular day, I did not have a response to that as a teacher.
For Labru, the response is still not complete, but it's gaining form.
We are here at the Vikas Valley Public School in Delhi's Uttam Nagar area, where Slam Out Loud has been conducting the Jijivisha Fellowship for a year. The fellowship places artists into the classroom of low income.
Welcome back. As flat can be on the indices, but we'll take the conversation forward. Ashutosh Bhargava, Fund Manager and Head of Equity Research at Nippon India Mutual Fund, is with us. Ashutosh, good morning, and thank you very much for being with us on the show. So we're all trying to sort of look for direction. I think the market's trying to make sense of things, and earnings are the real litmus test, right? We were looking at some of your earlier holdings. This is, of course, as of 2-3 months ago. Tell us if this has changed. But you seem to have a lot of large cap financials, particularly large cap banks in your portfolio. There's Axis, there's HDFC, there's ICICI. And if ICICI's numbers are anything to go by, this seems to be at least one pocket of the market that's rock steady and firing away. Your thoughts on financials, whether you've done any changes to your holdings, valuations, and whether you can still put more incremental money, fresh money to work in the same stocks?
Thanks, Subi. So yes, financials, we have been overweight, particularly on large banks. The reason is twofold. One is the valuations. I think valuation, despite the run-up in banking index, they remain cheaper versus their stocks' own history. They particularly remain cheaper versus the rest of the market and other large sectors like IT, etc. We have seen a massive amount of upgrades in FY24, throughout FY24, in banks earning. And we think at this point of time, the credit quality, whatever estimates we have on credit growth, and more importantly, the elevated margins that we are seeing, makes us believe that the 13-14% earnings growth, which is expected over the next 2 years, that estimates will easily be met from financial side. So both from the valuation perspective and more so from the earning resilience perspective, we think this is one sector which could continue to take market relatively higher.
Follow up, Ashutosh, on that. You mentioned margins. A part of the market, at least a section of the street, feels that we've seen the best in terms of margins and now it only comes down from here. Could that lead to some profit taking? Is that a concern you have?
So there's no doubt that margin re-rating has been very sharp, but we don't think that margins are going to come down materially. Yes, we might be near the peak margin, which some of the banks have also highlighted. But we think there are some levers which can keep margin at these elevated levels. And within banks, I think from the public sector bank side, there is still potential for margins to further go up because there is a significant section of assets which are still fixed cost in nature, and there is a potential for upward repricing of those assets in next 1 to 2 quarters. So there you could even see margin expansion. For the large private bank side, yes, you could be right that we are very near to the margin peak. But as I said, the hurdle rate is very low from banks' profitability expectations are concerned. 13-14% expectation for the next 2 years. I think that can easily be met.
Ashutosh, morning. Rima here. As a house, what is the call on investing in large caps, mid caps, or small caps? Because small caps have gone through a very long period of underperformance. I think in the last 5 years, the return has been negligible, practically flat. The markets at the same level as what they were in January of 2018, thereabout. So given the kind of underperformance, the time correction that we've seen, and the fact that valuations are also fairly reasonable in small caps, would you recommend a higher allocation in your SIPs to small caps versus the large caps? What's the house call here?
As a house, we believe that there are opportunity in all the 3 size category, large cap, mid cap, and small cap, and we are not particularly tilting over one over the other. What we think, the better approach would be to look at sectors where this year there could be some bit of top-line recovery, because that won't be there in a lot of sectors. But there is a reasonable amount of margin recovery, which I think could be there in a lot of sectors in FY24. And try to find bottom-up ideas across 3 market sizes. Purely from valuation perspective, when we look at small and mid-cap valuation discount to large cap, that doesn't give us a lot of comfort to squarely and overly go over, overweight on mid and small cap over large cap. But the point is well taken that over the last 18 odd months, the broader market or the side market, there the overall time correction and valuation correction has been more pronounced. But it's very difficult to be overweight on one over the other.
Okay, so you're not really recommending a move away from large caps to small and mid caps. And you did say that you will have to look at specific sectors to find opportunities, or even specific stocks. You want to take us through some sectors? I know you like the financials, like you mentioned, but anything else where you think overall that sector is likely to do well, even in a very range-bound kind of market?
That both local and global nominal growth would be under pressure over the next few quarters. What will drive earnings and perhaps the stock returns would be margin. And I think there are sectors where you could see a meaningful margin recovery, along with some bit of top-line support. Sectors like autos, pharma, utilities. So other than financial, these are the sectors where there is a potential for us to increase weights and be more constructive. Staples is another sector where we could see some margin upgrades and marginal, growth in terms of top line. But as I said, some of these domestic-oriented sectors like domestic autos, utilities, banks, these are the ones we have maximum confidence as far as earning resilience is concerned.
And you mentioned that you could look at increasing weights in auto and also auto ancillary, or are you looking at only autos for now?
So domestic-oriented companies is where we think there is more demand resilience, and domestic OEMs across the board is where we think there could be, upgrade possibility or earnings would be much better than the rest of the market. So this is where we would focus more on rather than, ancillaries where we already have exposure and they have some exposure in terms of global growth, which to our mind could be in the near term would be a challenge.
So by that logic, would you lower your weightage or downgrade technology?
So the thing with tech is that, if you just compare with, say, financial, there the valuation premium at which tech was trading, it has narrowed, but still remain at a premium versus the long-term history. So typically, IT index has traded on a one-year forward basis around 8 to 10% valuation premium, say, versus bank index. Today is still around 15% higher valuation premium. So we think that purely from valuation perspective, IT is not that attractive. And when we think from short to medium term earning potential, earning upgrade potential, I think banks are stand out, and we perhaps could see 1 or 2 more quarters of IT earnings to bottom out. So in that sense, we have remained underweight on IT versus financial, and I think that stance would continue for another 1 to 2 quarters. And then we reassess at that point of time for potential risk reward in the subsequent quarters.
All right, so not yet for IT names. Ashutosh, thanks as always for joining us and taking us through your call. That is Ashutosh Bhargava telling us that the sectors he still likes are the financials, some of the autos, and also stable names within the Indian market. But with that, it is time for a short break on the show. When we come back, we are going to talk about how the incremental business momentum has looked like in FY23 for the banking sector. It has been the best ever. We're going to bring you all of the details when we come back.
Walk along the streets of Kiev, of Kherson, of Kharkiv, and not a lot of people have a lot to say. Well, in Kherson, there's nobody around to say anything. In many parts of Kharkiv, there's nobody around to say anything on the streets. But war is on everyone's mind. How do you read that? Read it on the walls, on the paintings, the figures, the graffiti, the posters. Some people have said it there, others are seeing it there. Let's hear some of what Ukraine is saying without actually, of course, saying it. By the Krishatik street in Kiev, a row of posters remind passers-by of their Ukrainian past, as distinguished always now from a Soviet and particularly Russian past. Along the Freedom Square in Kharkiv, the word is out: keep calm and win. We will rule the cosmos. What is a marvel? It is the armed forces of Ukraine. Kharkiv is the hero city. Its people stand together. Everywhere, the walls speak their tribute to the fallen. A flag for every fallen soldier, but that was at the start of the war. There is no room for many more flags here at the Maidan in Kiev. The plaques are long out of date. Updating them is just too difficult. The call to arms, the call to back the armed, speaks on every street.
Welcome back. Now on to our special segment, Fin Street. Abhishek is standing by the big wall with all of the details on the FY23 business momentum for the banking sector. Abhishek, take it away.
Well, incremental business momentum for the banking sector in FY23 has been the best ever, with incremental deposit momentum of 15.8 lakh crore and incremental loan growth of about 17.8 lakh crore. Hence, the incremental credit deposit ratio or the CD ratio for the banking sector was at 113%, which is the highest in last 15 years. In a rising interest rate scenario, an increase in CD ratio augurs well for lenders, given the fact that it will help the net interest margin remain on the healthier side or not fall sharply. However, one can expect the net interest margin of lenders to decline from Q1 FY24 results onwards. This will be due to the fact that the rise in cost of funds for lenders will start kicking in as maximum hike on the lending side is already done or has taken place. Banking sector has ended FY23 with total deposits of 180.44 lakh crore and total loans of about 136.75 lakh crore. The credit deposit ratio for the sector for FY23 is the best in last 3 years, coming in at 75.8% when compared to 72.2% in the previous year. Now, deposit data shows that on an incremental basis, the growth in demand deposit is the lowest or slowest in last 3 years, while the incremental term deposit growth in a fiscal is perhaps the best ever that you have seen. Also, kindly note that some of the low-cost deposits may have moved to high-cost term deposit due to rise in interest rates that we saw in FY23. Now, sectoral data as of Feb 2023 shows that personal loan has been the big driver of loan growth in FY23. So as of Feb 2023, incremental loan growth has been about 15.6 lakh crore. A breakup shows that incremental loan growth has been driven by personal loans, which formed about 40.2% of the incremental loan growth. Services formed about 32.5%, agriculture about 12.5%, industry close to 9%, while food credit actually saw a decline nearly by 19,700 crores or about 1.3% year to date in Feb 2023 so far. Now, the loan breakup for the industry as of Feb 23 shows that personal loans formed about 29.8% of the loans, services formed about 26.2%, agriculture nearly about 24.5%, industry about 12.3%, food credit nearly 7%, and others about 0.26%. So in terms of outlook, the loan growth may slow down going ahead. Higher repayments of principal amount in the EMI can also lead to slowdown in the loan growth rate. Inflation, that can also hurt the loan growth for the banking sector in coming quarters. However, the key to watch will be the deposit momentum. The war has already started on deposit rates, especially by HDFC Bank, which is offering one of the highest term deposit rates amongst large peers. Now, private banks have gone back to branch expansion in order to grow their balance sheet. PSU banks, many have seen their balance sheet grow due to the foreign book as well. So with slowdown in global economy, we will need to watch out for the performance of overseas book for some of these PSU banks.
Abhishek, busy day for you. Thank you very much for joining in with that. Out of time on Trading Hour from the entire team. Thank you for watching.
For March 2023, the credit card spends grew by 28.2% YOY and about 15.7% on a month-on-month basis to more than 1,35,000 crore. While monthly spends are the highest ever for the credit card sector, the credit card issuances also have remained healthy as always. So in March 2023, the credit card issuances grew by 2.3% month-on-month and about nearly 16% on a YOY basis. Card issuance growth is the best in last 9 months. average spends was at about 16,143 rupees, which is up 10.6% YOY and about 13% on a month-on-month basis. So average spends are the second highest that you are seeing post Diwali. Let's look at the top 4 performance. So performance for March, now with Citi's number being in the Axis details, a card market share for the top 4 has risen to 71.37% when compared to 68% in the previous month. Spends market share is at 74.74% for the month of March versus 71.9% on a month-on-month basis. Remember that Axis Bank's numbers now have Citi's numbers as well in March. So spends market share in spends is at 12% for Axis Bank versus 9% month-on-month, a gain of nearly about 300 basis points, while credit card issuances market share for Axis Bank now is at 14.2% versus 11.5% on a month-on-month basis, a gain of more than 270 basis points month-on-month. So in the top 4, due to Citi acquisition, Axis Bank has gained market share in spends by about 321 basis points. Ex-Citi, Axis Bank would have gained market share by 24 basis points. HDFC Bank has gained market share by almost 82 basis points to 27.4%. The top loser is ICICI Bank by about 189 basis points. Now the market share is 17.4%, and for SBI the loss is about 111 basis points, with market share being now at 17.9% on a YOY basis. So credit card issuances, SBI card has gained market share by 202 basis points YOY to about 19.65%. Axis Bank, due to Citi acquisition, has gained by 195 basis points to about 14.2%. ICICI Bank has seen a reduction of 175 basis points to about 16.95% now, and HDFC Bank has seen reduction of 190 basis points in the market share to about 20.56%. Top 4's market share in total cards has moved to about 71.06% that you had in March 2022 to right now about 71.4% in March 2023, a gain of 32 basis points, and that was largely for Axis Bank due to the Citi acquisition. Outlook on credit card issuances is that it remains strong in terms of, the credit card distribution. On expected line, spends have increased due to summer holidays. You need to watch out for the revolver rates, which are on a declining trend for the entire sector. Now, many private lenders are still going out with huge offers on credit card to their customers, so that needs to be seen how that will move ahead. Holiday season could keep the spends on the healthier side. You need to watch out for the inflation if that impacts on the spends of credit card, if any.
The movie Three Idiots was the first time many Indian households got acquainted with the concept of drones. And prototype of the drone used in the movie was developed by a homegrown startup called IdeaForge. IdeaForge is now a pioneer in the Indian unmanned aircraft systems with a market share of nearly 50% in 2022. The company has nearly 20 patents registered. It has deals with Indian Armed Forces, state police forces, and organizations like DRDO. In April 2022, it backed $20 million in its Series B funding round from several investors, including Florentry, Infosys, and Exim Bank of India, among others.
India is getting excited about the flourishing drone industry as it aims to be the global drone hub by the end of the decade. These steps like liberalization of the drone rules, rationalization of the norms of the drone pilots, and establishment of the drone schools have given new direction to the industry. The recent allocation of rupees 120 crore under the PLI scheme in the recent union budget acted as a booster dose for the Indian manufacturers.
Even just a few years ago, drones were considered a niche industry, but now investments are starting to pour in. Ankit Mehta, the CEO of IdeaForge, which was formed in 2007, has witnessed a complete transformation in government policies and investments throughout the years.
I've in a way seen the drone regulations go from, ignore to deny to accept to support. That whole cycle we have seen, right, from the very beginning. And absolutely, we are delighted to know that now it is a regime that is enabling. It is a regime that wants to deploy these systems in an environment where
Stocks slip after a firm opening as the street remains wary in a highly uncertain global environment. Financials and realty manage gains, while pharma, utilities and capital goods drag.
Reliance Industries beats its street expectations with profits growing 22% quarter-on-quarter, led by this oil-to-chemical segment outperformance. Analysts are also upbeat on the company keeping its net debt in check.
And the Reserve Bank allows HDFC Bank more time to meet priority sector norms and allows HDFC Group to up its stake in its insurance arm, but doesn't offer any concession on the CRR or the SLR. The news fires up HDFC Life.
ICICI Bank delivers a record-breaking performance with the highest ever margins for the company, quarterly income growth, return on assets and return on equity as well. The stock, as a result of which, perks up. Good afternoon, hello and welcome. You're watching us here on Halftime Report. It's halfway through the trading session. I'm Manglam Malu, with me as always Sonia and Ekta. You know, we had thought on Friday that post-Friday, the results that will come in from Reliance and ICICI Bank will move the market out of its funk. But that wasn't the case to be. All of last 3 days, we moved about 3 points and now we're up around 2 points.
Oh, absolutely. You know, that was the narrative at the start of trade, right? And look at the markets. Just doesn't oblige when you want it to, I guess. But let's see. For now, ICICI Bank is still a great set of numbers. I think the drag really is coming from a lot of the other heavyweights, whether it's ITC today, whether it's a lot of the technology names as well. But there's a long list of earnings coming through the course of the week, so plenty to talk about today.
Hi, Sonia. Yes, absolutely. For example, we have Bajaj Auto tomorrow, so that would be important to watch out for. But nonetheless, let's start with ICICI Bank, because that one has actually enthused the street in terms of what it reported. No negative surprises. This comes after HDFC Bank last week. So let's talk a little more about ICICI Bank in terms of its fourth quarter numbers. Abhishek is here with the fine print and what he made of it.
Well, you know, Sandeep Bakshi has created history for ICICI Bank in Q4 FY23. So records continue to gather as a net interest margin of 4.9% is the highest that they have ever seen. The domestic net interest margin has crossed the 5% level, and the international net interest margin is also at 26 quarter high of more than 1%. So the NII growth is perhaps one of the best that you are seeing in last 8 to 10 years, given the fact that it's a growth of 40.2% YOY, which has aided the PAT or the earnings or the bottom line of the bank being the highest ever in terms of quarterly performance. So highest ever quarterly return ratios as well. The return on asset is at 2.39% and the return on equity is at 18.9%. Asset quality continues to improve. The gross NPA ratio has come down to 2.81% and net NPA ratio at about 0.48%. So the asset quality is one of the best that you are seeing in last 33 quarters or even more. Unsecured book is the highest in last 22 quarters. The proportion of that unsecured book in the overall loan mix is now at 19.4%, which continues to aid in net interest margin being on the higher side. On the flip side, the deposit growth, that's a bit worrisome. It's come in a little less than 11%, and going ahead, management has indicated that the net interest margin may not be sustainable at current levels, but 5% net interest margin on domestic business, even a small decline will go well with investors. P&L, both in terms of NII and PAT, it's a beat on our poll. Brokerages remain upbeat on the stock. They say that the ROE will increase to about 17 to 18% for the full year by FY25. So they raised their estimate by 3 to 9%, and they say that uptick in deposit mobilization will be a plus point given the fact that FY24 loan growth will be strong. Across brokerages, the target price ranges from as low as 1100 to as high as 1200 per share. Back to you.
All right, Abhishek, thanks a lot for that. So that's about ICICI Bank, the top gainer on the Nifty Bank today, up around 1.5%, and the top contributor out there as well. In fact, let's also listen in to what the MD and CEO Sandeep Bakshi had to say on the numbers in the company's earnings conference call.
Including non-fund based outstanding, the retail portfolio was 45.7% of the total portfolio. The business banking portfolio grew by 34.9% year-on-year and 7.8% sequentially. The SME portfolio grew by 19.2% year-on-year and 6.2% sequentially. The growth in SME and business banking portfolios was driven by leveraging our branch network and digital offerings such as InstaBiz and Merchant Stack. The domestic loan portfolio grew by 20.5% year-on-year and 5% sequentially. The overall loan portfolio grew by 18.7% year-on-year and 4.7% sequentially. Looking ahead, we see many opportunities to drive growth in the risk-calibrated core operating profits. We believe our focus on customer 360, extensive franchise and synergy and collaboration within the organization, backed by our digital offerings and process improvement and service delivery initiatives, will enable us to deliver customized solutions to customers in a seamless manner and grow market share across key segments. We will continue to make investments in technology, people, distribution, and building our brand.
Okay, that's Sandeep Bakshi, who has pretty much changed the fortunes of ICICI Bank ever since he came on board. And of course, the stock has been doing pretty well too, up almost 1.5%. Let's step into a quick break. But on the other side, we'll put our focus on the hospital space as the sector has seen a rise in M&A activity this season. More on that coming up.
For March 2023, the credit card spends grew by 28.2% YOY and about 15.7% on a month-on-month basis to more than 1,35,000 crore. While monthly spends are the highest ever for the credit card sector, the credit card issuances also have remained healthy as always. So in March 2023, the credit card issuances grew by 2.3% month-on-month and about nearly 16% on a YOY basis. Card issuance growth is the best in last 9 months. Average spends was at about 16,143 rupees, which is up 10.6% YOY and about 13% on a month-on-month basis. So average spends are the second highest that you are seeing post Diwali. Let's look at the top 4 performance. So performance for March, now with Citi's number being in the Axis details, a card market share for the top 4 has risen to 71.37% when compared to 68% in the previous month. Spends market share is at 74.74% for the month of March versus 71.9% on a month-on-month basis. Remember that Axis Bank's numbers now have Citi's numbers as well in March. So spends market share in spends is at 12% for Axis Bank versus 9% month-on-month, a gain of nearly about 300 basis points, while credit card issuances market share for Axis Bank now is at 14.2% versus 11.5% on a month-on-month basis, a gain of more than 270 basis points month-on-month. So in the top 4, due to Citi acquisition, Axis Bank has gained market share in spends by about 321 basis points. Ex-Citi, Axis Bank would have gained market share by 24 basis points. HDFC Bank has gained market share by almost 82 basis points to 27.4%. The top loser is ICICI Bank by about 189 basis points.
Well, as promised before the break, we're now going to talk about the hospital sector. Now, this sector has seen a rise in M&A activity this season. Ekta is standing by the big wall to tell us about the whole host of deals that have taken place in the sector. Ekta, over to you.
Thanks for that. Well, yes, the hospital sector is abuzz with deals, from Singapore PE fund Temasek becoming the majority stakeholders in Manipal hospitals after buying an additional 41% stake for around 16,400 crores, to smaller deals such as Fortis picking up a 350-bed hospital near Delhi for around 225 crores. Other deals in the offing could be Abhay Soy promoted Max Healthcare picking up TPG-run Care hospitals. An Economic Times report is pegging valuations for the deal at anywhere between 5,500 to 6,500 crores. Other deals in the offing include Manipal itself buying the hospital chain of Imami Group AMRI for around 2,400 crores and picking up Kerala-based private hospital chain KIMS for around 3,500 to 4,000 crores. Acquisitions are done for various reasons, from increasing the geographic presence to accessing pan-India multi-speciality bed capacities quickly. For example, Fortis, with the acquisition of Meteor Hospitals, will be propelling to become the second largest hospital with bed capacity in Gurugram. It will fulfill its strategic approach of expanding in the Delhi NCR geographic cluster. On the other hand, Manipal could surpass Apollo hospitals by increasing their bed capacity to over 10,000 beds in case the said acquisitions go through. And Max, which has over 3,400 bed capacity, will access 2,400 beds from care hospitals, helping it achieve targets of increasing its bed capacity by over 2x in the next 3 to 4 years. The common thread amongst all these acquisitions is cashing in on the structural growth drivers, hence many are ready to pay top dollar for these acquisitions. Valuations for the hospital space have risen as much as 8x in the past 5 years, with deals such as Manipal Temasek done at 10 times MCAP to sales, which is a premium of 5 to 6 times versus peers. These structural growth drivers include increased health awareness and insurance penetration post-COVID-19 and increased inflow from international patients as India positions itself as a medical tourism hub. All this will help aid the operations of the hospitals. For example, average occupancies in the hospital space are expected to go from the current range of 65 to 69% to over 75%. Average occupied bed rates could rise by around 10%. As far as medical tourism goes, it has risen 30% from 2014 to 2019, with currently many of the large hospital chains seeing business revert back to pre-COVID-19 levels. Estimates are the number of medical tourists could rise to 3 million by 2030. Lastly, why acquire? Today, building a hospital requires a capex of around 1 to 1.2 crores per bed over and above land acquisition costs and other costs, resulting in a time frame of up to 3 to 4 years to even come on stream. Acquisitions are cheaper and more cost effective. Acquisitions, hospital owners and analysts say, is cash accretive from day one due to the immediate and fast without capital to invest and build. All this hence aiding cash management and possibly even justifying the valuations. In fact, we have with us Viren Shetty, who is the Executive Director and Group COO of Narayana Health, and we have with us Dr. Balal of Manipal Hospitals joining in now to discuss all of the M&A activity. Gentlemen, welcome to this discussion. Dr. Balal, I'm going to start this discussion with you, considering that Manipal has really been in the news in the past couple of weeks. Give us the reason why Temasek was so interested in Manipal. What was the reason for the acquisition and the kind of premium that you all also got?
Good afternoon, Ekta. Thank you for having me here. Good afternoon, Viren. I think we are in a very exciting period. M&A seems to be the flavor of the season. Temasek is not new to us. They have been our shareholders for quite some time. They have been on the board too for the last 6 or 7 years. And they have seen the practice of medicine grow significantly in the Manipal sector. And they are very, very comfortable with what Manipal is. And I'm sure that's one of the reasons that they've invested in healthcare. In addition to the belief that healthcare is sort of going to surge ahead, and the setback that was there during COVID, I think we have overcome that. And we are looking forward to a very healthy growth in the future. I think our familiarity, our culture, and the future growth of healthcare is what Temasek saw in us.
Okay.
Right.
Sorry, Viren Shetty is also with us. He's the Group CEO of Narayana Health. Viren, do you see a lot more deals in the pipeline now? I mean, there's clearly a lot of interest in this space. And as Ekta was pointing out, perhaps valuations are also looking good. Assets are there for the asking. What is your own view on what the size and scope of these deals could be in future as well?
There are a lot more deals that will come about. And as you said, the valuations are looking good for the seller. For the buyers, of course, these things tend to be quite expensive. But I guess institutions like KKR, Temasek, Carlyle have all done their homework, and they figured that there's a lot of opportunity to make back the returns from how much they're investing in making these expensive acquisitions.
Right. Recently I put out a piece comparing hotels with hospitals in the sense that both their businesses are similar, where you have to obviously put up a facility and thereafter you earn off occupancies, with the obvious difference being that hotels is cyclical, whereas hospitals is a lot more structural. Dr. Balal, I just wanted to understand your thoughts on, have we moved up in this structure of return ratios and businesses for hospitals, from a business standpoint over the next 5 to 6 years?
I agree with you. I think there's a lot of advantages of acquiring chains of hospitals rather than greenfield projects, which take a very long time to start making money. So there's a significant advantage of acquiring large-scale hospitals. And what we have seen is a steady growth of at least 10 to 15%. And we should actually look at the growth from 2019 onwards, because 2020, 21, 22 were retarded growths due to the COVID pandemic. But certainly all of us are growing at a healthy level, and we do believe our occupancies will go from 60 to 65% to about 70 to 75% in the future. And I think acquiring hospitals is probably the better way of doing business. However, we are also looking at many greenfield projects, mostly in the places that we are already well established.
Okay. Viren, I just wanted to understand the premiums. For example, the Manipal Temasek deal was done at some of the heftiest premiums that we've seen in the hospital space, at around 10 times MCAP to sales. And if you compare it to its peers, the peers are still at anywhere between 4 to 6 times. Based on this expensive deal that's taken place, do you expect the valuations to become more expensive for further deals going forward?
Well, to be fair, that Manipal is a phenomenal hospital group, and it is a marquee brand in their key hospitals. So it may not be shared by hospitals that aren't of the same caliber, but for hospitals that are, I would guess it would drive up the valuations, yes.
Okay. Just on that point, Viren, are there any distressed assets within the hospital space which are for easy pickings at this point? Because one of the trends that took place post COVID-19 was that the stronger players managed to emerge, and maybe the smaller hospital companies couldn't cope. So is that a type of trend which is also taking place?
Well, hospitals have been distressed even before COVID-19, and for multiple reasons. But the reasons these hospitals end up being distressed does not go away just because you get a much larger parent to take it over. Sometimes it could be location, sometimes it could be just spending too much on a building, sometimes it could be all kinds of regulatory issues. None of that goes away. And anyone that's looking to make a cheap acquisition of a distressed asset will end up inheriting a lot of the headache that came with the reason that hospital was distressed. So it's not always cheaper in that sense or easier. It's just a question of how much time and money you're willing to commit in the pursuit of growing a large network full of beds.
I want to go to Dr. Balal, but before that, Viren, at the end of the day, for someone who's watching our show, right, what matters is in the hospital space, if occupancies are rising, if medical tourism is back in a big way. And I'm sure, the M&A guys, the PE guys who are investing are expecting these trends to improve, and hence the future looks good as well. But you tell us, what are the numbers right now? Have occupancy levels risen? Has medical tourism come back in a big way? And what do you see as the way forward, say, over the next 12 to 18 months?
It's always hard to project how things work out in this sector. The fact is there was a huge lag during the COVID time, and people were not getting elective surgeries done, which has bounced back. And with increase in general awareness about your healthcare, so a lot of people have realized that they need to get checkups done, they need to start taking care of their health more, and that ends up with them being consumers, active consumers of healthcare. But still, there is tremendous room to grow, because as a country and as a people, Indians are the least likely to seek medication, the least likely to access healthcare, have some of the worst health outcomes for people of the similar genetic disposition. And it just means that there is a large market for people who need to access healthcare that there is their right to. So regardless of the international expansion, regardless of how you look at it, people do need more healthcare, and hospitals are here to provide that so that they can live long, healthy and productive lives.
Right. People do need more healthcare. We've learned that during the pandemic more than ever before. But Dr. Balal, just wanted to understand a couple of things from you. One is that is there enough supply of quality talent in the hospitals business? While it's easy for everyone to go ahead, acquire companies, pay top dollar, acquire or build facilities so that there is enough infrastructure, but the soft skills of surgeons and good quality doctors, is there enough in the supply pipeline for the same? And secondly, where exactly does your deal with Imami stand at right now with regards to AMRI? Is everything done?
To answer your first question, Ben, I fully agree with you. I think hospitals are not just brick and mortar buildings and CT scans and MRI, PET scans, etc. It's really the human resources that make a hospital what it is. In the cities, it's certainly not a big problem of getting talent, because most of the qualified doctors, specialists tend to sort of gravitate towards the cities. And by and large, in the cities, we haven't had much of a problem. And so far, most of our hospitals have been in the Tier 1 cities, except our teaching hospitals, where it's a different ballgame altogether. So far, we haven't had too much of a problem acquiring talent because of where we are located. And also, most of them are about 250 to 300 bedded tertiary quaternary care hospitals. But it may be a problem in the future, because what we see is more than shortage of doctors, it's an inequitable distribution of talent. You go to a place 100 miles away from Bangalore, it may be very difficult to get a good surgeon, certainly very difficult to get a good transplant surgeon or a cardiac surgeon. So I think so far the problem has been manageable. And also we have the synergy of having a large number of hospitals, at least in some of our locations like Bangalore. The second is, you asked me about Imami. I would not comment on anything more, saying that we are in the advanced stages of negotiation, and hopefully you will know very soon.
Okay, well, that is definitely some of the statistics that we do need to improve, the doctor-patient ratio, the nurse-patient ratio across India. But I'm going to request Dr. Bilal as well as Viren to stay on. We need to take a short break, but we'll be back with more questions on M&A activity in the hospital space. Stay tuned.
सदियों से चुप बैठी आज मुंह खोलूंगी तोड़ के दरवाजे सारे आज सच मैं बोलूंगी सहनशीलता को मेरी कमजोरी ना समझो तुम.
It's rare to see a 12-year-old speak about gender stereotypes, but for Swati, it's normal. She and her classmates have been part of Slam Out Loud's Jijivisha program for the last 8 months. And for them, such performances are a learning experience that teaches life skills and awareness around cultural and social issues. Swati is among around 12,000 children from disadvantaged communities across 5 Indian states who are learning creative confidence skills under Slam Out Loud's unique program that uses performance and visual arts to build socio-emotional learning skills.
For children who come from low-income backgrounds, all we do is restrict what we do with them to either academics or at best getting a job. And I thought somebody should be doing something about these children.
But what led to this idea?
One day I actually landed up in Kashmir, and when I walked into that class, I was doing this workshop. I asked children to pick an emotion and write a small poem on that emotion. And most children, like about 30 out of 35 children in that classroom, ended up writing about emotions of anger, confusion, sadness, hate, feelings of isolation. And I think on that particular day, I did not have a response to that as a teacher.
For Labru, the response is still not complete, but it's gaining form.
We are here at the Vikas Valley Public School in Delhi's Uttam Nagar area, where Slam Out Loud has been conducting the Jijivisha Fellowship for a year. The fellowship places artists into the classroom of low-income schools. Slam Out Loud in-person programs serve around 12,000 disadvantaged children across India and 5 million children globally through their online programs.
The going has not been easy because for so many schools catering to children from low-income households.
Welcome back. We still have with us Viren Shetty, who's the Executive Director and Group COO of Narayana Health, and Dr. Bilal of Manipal Hospitals joining in to discuss the hospital space in India and the kind of M&A we've seen recently. Viren, one of the trends which has also stood out within the hospital space is the interest from PEs within hospitals. We've seen deals such as Manipal Temasek, TPG Care, KKR Max, just to name a few, even the likes of HCG, CVC Capital. What happens when a PE firm buys into a hospital company? Because eventually they do want to exit with higher returns. So how does that affect the operations? Are we going to see more deals coming in from the PE front when it comes to hospitals?
See, PE funds chase yield. more than anything else, they invest in sectors where they see some inefficiencies and underperformance, and they're able to increase the yield of the assets that they acquire, not just in healthcare, in most industries across the world. And the Indian private healthcare industry does owe a great deal of gratitude to a lot of the PE funds who first put us on this journey of become professionalized institutions, because I'll just speak from our own experience. Prior to us bringing in professional investors, we didn't even have a proper accounting system. We had no idea how much material was coming back and forth. We had no idea of how to generate bills on time, how to collect them. And so that discipline of being financially rigorous is something that PE funds bring to every hospital that they acquire, and that is of tremendous value. But of course, beyond the point, you're looking at a sense of maybe diminishing returns, in which case if you are buying in to a healthcare group at a very high valuation and you're looking to 2x, 3x, or 10x that investment, it would mean that you would have to be a little more aggressive in the way in which you run your operations. And that is fine to an extent, because a lot of aggression does come from how you expand, how you grow, how you add beds, and are able to project a view of the future that could square with the reality of a market like India, which is growing very quickly. So I would say that it affects the operations in that it does cause hospitals to be more cost efficient, to be able to offer more services to charge, and to be more aggressive in their growth.
Dr. Balal, of course, on one hand, when PE investors get into a certain type of investment, they're looking at, tightening the ship or cost effectiveness, etc. But the other thing is structural growth drivers, right? And Ekta was pointing out a couple of growth drivers that the space is seeing, whether it's higher insurance penetration, pickup in medical tourism, which was missing for a very long time. But you tell us, going forward over the next couple of years, what do you see as the main growth driver for the hospital's business?
I do agree with you. I think private equity has contributed a lot to growth of the healthcare sector. We have particularly been with the private equity for quite some time. And as Viren mentioned, I think there is certainly a much better management, a tighter control of what's happening, and a more closer look of how the hospital is administered and how it grows. Everyone looks for return on the investment. So I think these are all needed for us to grow. The future, as I see, is one, certainly I think we'll have more healthcare awareness, hopefully more insurance penetration of bringing in more patients who require healthcare, and certainly more of medical value tourism. And hopefully at some point, there will be a percolation down of significant healthcare institutions to the tier 2 and tier 3 cities, which is bound to happen. Just like how it has happened with specialists, once a city like Bangalore is sort of saturated, we see a lot of specialists, nephrologists, cardiologists, so on and so forth, moving into other towns where there is growth. So I think this will be the pattern for the future. But I am quite optimistic that healthcare is here to grow, and it will grow significantly in the next few years. And it needs to grow in a large country like ours. And soon, hopefully, we'll be the healthcare givers for the world, like what the Western world was in the past.
Point well taken, Dr. Balal. Viren, I just wanted to probe a little further on this. While healthcare needs to grow, are there any trends that you're seeing? A certain kind of hospital is seeing a faster growth, or is there a latent need for something which you believe can be a growth driver in the future? I mean, we are all talking about specialty hospitals, we're all talking about general care hospitals, but anything specific that you see as maximum growth potential?
See, there is a demand for healthcare that will continue unabated. But the problem that happens is that there are vast segments of the population that are simply not able to afford the sort of treatments that are being offered. And so when we look at our expansion, there is a need for tier 1 cities. There is a different sort of hospital that you create for tier 2, tier 3, and even in the tier 1 cities, there are different payer groups that you're going after. More than growth of people who have insurance, or people who are flying in from abroad to get very high-end treatment done here, the greatest need is for the middle class, the lower middle class, and the poor farmers of this country, for whom there still needs to be a lot more cost rationalization. There still needs to be a lot more efficiencies brought in from the private sector to be able to service that. So we see that as some of the growth drivers for our group, which we call, and has been termed as the missing middle. And so they need insurance, they need healthcare, they need primary care, they need preventative care, they need lab tests, all at a price that is much lower than what is being provided, even in our group today. And so a lot of the effort that we're putting in is towards servicing that need. Now, it does not necessarily mean that we need to add more beds to achieve that we need to add too much more expensive infrastructure to achieve that. There is a lot of soft efforts that we need to do on our processes, on the way in which we discharge patients, process them, and the amount of throughput we can put in that can help reduce our cost even further and take care of those patients. So we see a lot of growth coming in from India.
I'm just going to interrupt and ask you, what's your plan when it comes to M&A? Are you looking to be acquired? Are you looking to acquire? Because Narayana has been relatively, I'm saying relatively, quiet as compared to the peers when it comes to M&A.
Yeah. See, all of this costs money. And who pays for it at the end of the day? It's not Temasek or KKR. They're just lending money to the hospital group to do its expansion and so on. In the end, these costs are borne by the patient. And unless the things that we spend money on improve the healthcare outcomes for them, reduce the cost, allow us to do more with less, it doesn't make sense for us to spend huge amounts of money towards M&A. Now, it's not that we don't do M&A, we do. It's a lot smaller, it's a lot more gradual. But the things that we are pursuing are the cost reduction that is desperately required in this sector.
Okay, cost reduction is the need of the hour in this sector. Got that. Viren and Dr. Balal, pleasure speaking with you to understand what's happening in the business and what the way forward could look like. Appreciate your thoughts on CNBC-TV18. Thanks a lot for joining us.
Very much. Thank you.
All right, let's do one thing. It's a very quiet market, so let's slip into a short break. On the other side of the break, Kishore Roongta, who's the Chairman and Managing Director at FACT, will join in for an outlook on their business. Stay with us.
Walk along the streets of Kiev, of Kherson, of Kharkiv, and not a lot of people have a lot to say. Well, in Kherson, there's nobody around to say anything. In many parts of Kharkiv, there's nobody around to say anything on the streets. But war is on everyone's mind. How do you read that? Read it on the walls, on the paintings, the figures, the graffiti, the posters. Some people have said it there, others are seeing it there. Let's hear some of what Ukraine is saying without actually, of course, saying it. By the Krishatik street in Kiev, a row of posters remind passers-by of their Ukrainian past as distinguished, always now, from a Soviet and particularly Russian past. Along the Freedom Square in Kharkiv, the word is out. Keep calm and win. We will rule the cosmos. What is a marvel? It is the armed forces of Ukraine. Kharkiv is the hero city. Its people stand together. Everywhere, the walls speak their tribute to the fallen. A flag for every fallen soldier, but that was at the start of the war. There is no room for many more flags here at the Maidan in Kiev. The plaques are long out of date. Updating them is just too difficult. The call to arms, the call to back the armed, speaks on every street. An SOS for ammunition, cry against war, a sting.
Welcome back to Halftime Report. In the last 20 years, India witnessed double-digit monsoon deficit 3 times, and Centrum in a recent note indicates that India's monsoon patterns are always different. So to decode the impact of extreme weather on the fertilizer sector, we're joined by Kishore Roongta, the Chairman and Managing Director at FACT. Mr. Roongta, good morning and thanks a lot for joining in. Before I ask you about your own business, there's lots happening as far as the monsoon situation is concerned. There's a possibility of an El Nino. There's also unseasonal rains which has impacted the crop quite a bit. Your own business has, of course, had a decent trajectory, but given that we are staring at perhaps what could be a volatile monsoon season, how do you think all of that would impact your business? How has extreme weather hit your business in the past?
Yes, fine. Good morning. I would like to tell you one thing, that if you see the IMD predictions, the monsoon is predicted at 96%. So which is more or less normal. And if you see the prediction for the southwest regions, it is being informed that it is going to be normal. Right now, what heat waves we are going through, definitely it has got impact. But anyway, the month of March, April is the lean period for all the fertilizer companies. So we don't sell much of the product in these 2 months. But from May onwards, from 20th of May onwards, we feel the demand will be as normal as it was there in the last year. So we don't find any difficulty in selling our product for the company and for the industry as a whole.
So, Mr. Rungta, can you quantify that? Because I'm sure you must be getting the trends intact because sales are going to pick up May onwards. How does it compare, say, to last year? And what are you predicting for the entire season?
Yes, this is a Kharif season going on. Basically, the season will start from 15th of May to September till 30th September. And if you see the last 2 years, the total consumption was 305 lakhs metric ton of various grade of fertilizer. So we are anticipating that in this Kharif also, the total requirement will be 305 lakhs metric tons. And in the Rabi season, which will start from October to March 2024, that will be 320 lakhs metric tons. So it will remain more or less intact.
All right. Mr. Rungta, I just wanted to know your thoughts on the nano fertilizer segment. I mean, we had the fertilizer secretary speak about that. Are you looking at manufacturing nano fertilizers as well? Have you announced any sort of, investment behind this?
Nano fertilizer, right now only IFCO is making. We have signed an MOU with them that we are going to market the nano fertilizer in the southern India. So that is the only understanding we have done with the IFCO. So right now we will be only selling nano urea, which is being produced by the IFCO. We are not going to manufacture nano urea in our plant.
Okay. So you're not going to, so there's no additional investment that you're looking at doing for the nano fertilizer segment?
No, we are not going to add nano fertilizer production in our basket. Okay. But of course, we are going for capacity expansion. We will produce another 5 lakhs metric. That capex is going on.
So can you tell us about the capacity expansion? What are the plans? What will the capacity look like, say, 1 year down the line? And how much would you be investing? Will it be largely from internal accruals? Are you looking to, take on any debt?
Yes, here it is like that. We are going to spend almost 700 crore rupees for the capacity expansion. Our projects are going on, and we are going to add this another 5 lakhs metric ton of fertilizer in the month of, by end of 2024. So with this, my total production capacity will be 15 lakhs metric ton. Right now, we are producing 10 lakhs metric tons. We'll add another 5 lakhs metric tons.
Okay. The prices of natural gas have been revised. For example, from April 8th to the 30th, it has been set around $7.9 per MMBTU. What is the impact on the business?
Yes, see, this impact, what you are talking, that is basically for the pool gas price, and that is being supplied only to the urea plants. We are not manufacturing urea. We are manufacturing only complex fertilizer. So the impact of this will not come to FSCT at all.
All right.
You had sold almost 500 acres of land in FY20. That's 482 acres. Wanted to know if there is any more non-core land that you have which you wish to sell or monetize when that happens. And secondly, the subsidy that's outstanding from the government under the DBT regime.
Yes, you said correctly. Whatever we have sold prior to the previous year, 1920 and 2021, with that money we are going to add to the capacity expansion. And that is why we are not borrowing any money from the banks or institutions for the capex project. And right now, whatever surplus land was there, that we have already given to the government of Kerala, and there is no further surplus land available to us. Whatever tidbits lands are there, that will be used only for our expansion plan. So we are not going to do further monetization of the land. That is number one. And number two, with respect to subsidy, the government is going to announce the subsidy very soon. And till March, government has already cleared all the subsidy dues to FSCT. So we don't have much of the outstanding now.
Just a follow-up on that, you said that gas price cuts will not impact you, but how is it that it will not impact you? Because you use it as a raw material, right?
That's correct. But see, what you are talking is a pool gas price. Right now, what we are buying is from the market. We have made a long-term contract with the IOCL, and we have tied up with the Gorgon gas. So whatever will be the Gorgon gas, that will be given to the FSCT, and this tie-up is for the 5 year with IOCL. So right now, the natural gas price, what you are talking, that will not have any impact on FSCT.
So, but this tie-up that you've had, is it at a fixed price? This tie-up that you've had with IOC, and what price is it?
It's not an international benchmark price. It is with the Gorgon price. So whenever price goes up and down, it will have impact on us. Right now, price is in the decreasing trend.
Okay, just a quick word with regards to your input costs in any way, sir, because there were, there were reports doing the rounds that in the month of Feb, there was a hike by complex fertilizer manufacturers because of input costs rising. Where do things stand? Have you taken a price hike? Are you covered in terms of the incremental input cost price rise that we've seen?
Yeah, you said correctly. Last year, the price has shot up by almost 200-300%. But the government subsidy, if you see, it was increased from 1.75 lakhs crore to 2.25 lakhs crore. So the government has insulated. We have not increased the price at that point of time because we were getting additional subsidy from the government of India. So that is where we did not increase the price in last year. We kept the control on the MRP.
Okay, all right. Sir, thanks a lot for joining in. We've run out of time, but thanks for giving us, an update on the business and the way forward as well. Let's slip into a quick break on that note. On the other side, we'll get you more markets, more stock-specific action. The market is very quiet, but the Bank Nifty is doing quite well, 300 points in the green. So more on that coming up.
For March 2023, the credit card spends grew by 28.2% YOY and about 15.7% on a month-on-month basis to more than 1,35,000 crore. While monthly spends are the highest ever for the credit card sector, the credit card issuances also have remained healthy as always. So in March 2023, the credit card issuances grew by 2.3% month-on-month and about nearly 16% on a YOY basis. Card issuance growth is the best in last 9 months. Average spends was at about 16,143 rupees, which is up 10.6% YOY and about 13% on a month-on-month basis. So average spends are the second highest that you are seeing post Diwali. Let's look at the top 4 performance. So performance for March, now with Citi's number being in the Axis details, a card market share for the top 4 has risen to 71.37% when compared to 68% in the previous month. Spends market share is at 74.74% for the month of March versus 71.9% on a month-on-month basis. Remember that Axis Bank's numbers now have Citi's numbers as well in March. So spends market share in spends is at 12% for Axis Bank versus 9% month-on-month, a gain of nearly about 300 basis points, while credit card issuances market share for Axis Bank now is at 14.2% versus 11.5% on a month-on-month basis, a gain of more than 270 basis points month-on-month. So in the top 4, due to Citi acquisition, Axis Bank has gained market share in spends by about 321 basis points. Ex-Citi, Axis Bank would have gained market share by 24 basis points. HDFC Bank has gained market share by almost 82 basis points to 27.4%. The top loser is ICICI Bank by about 189 basis points. Now the market share is 17.4%, and for SBI, the loss is.
Welcome back. We're picking some pace for the market right now, up around 40 points on the Nifty, but still have been in a bit of a range today. Though the good part is that the range that we've seen today on the index is a little higher than the range that we saw for the last 3 days. So the last 3 days, every time the Nifty went closer to that 17,700 mark, we saw some supply. Today it went ahead and crossed that, and at lower levels as well. We went all the way up to 17,580, 17,550 to see some support, but today we found support at 17,620 itself. The Nifty Bank is the key contributor on the way up. In fact, as we speak, the Nifty Bank is up almost 1%, led higher by ICICI Bank, understandably because of its results, and post that we're seeing some support coming in from SBI and Axis Bank as well. Importantly, watch out for the Nifty as it approaches that 17,700 mark, because this is the expiry week and we've seen a fair amount of writing at the 17,700 call and the 17,700 put. So those who've written the 17,700 call expect the Nifty not to cross that 17,750 mark, whereas those who've written the 17,600 put don't